Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello friends, welcome to the session on revision for mutual funds chapter. This is an important chapter because we have had history of good quality questions actually coming from this chapter in exams. While there are a lot of concepts around theoretical aspects that have been asked, it is only, I think only once there is one specific small theory question that has been asked, but there is a lot of scope, and as we have seen the institute, the way it is changing, the question papers, or rather the way it is looking at setting question papers, I am pretty sure at some point in very near future we will see some good quality questions, theory questions specifically coming from this chapter. So in this revision session we will look largely at theory as well as practical aspects. So we will be covering the entire theory fairly quickly, and then we will go and solve some important problems. So first, what's a mutual fund? It is basically a trust that pools money from investors to collectively buy or own assets for mutual benefit of investors in proportion to the investment. So basically all the money. So how does it work? So if you look at this, all investors pool the money in a mutual fund, say HDFC fund or ICCA mutual fund. The fund has various schemes. So what are schemes? We will understand that as we move forward. Assume for a moment that there is one particular scheme in which they all invest. That money is managed by a fund manager. So there is an entity, there is an individual called as a fund manager who manages the money and invests it in financial markets. So the end goal is that you pool money. We all pool money, give it to a fund manager who is an expert in managing money, who's an expert in portfolio management, who's an expert in equity markets, debt markets, who understands how financial markets function, and that person eventually makes investment in financial markets. The fund is managed by a professional investment manager known as fund manager, and the fund manager invests the money collected from different investors in various stocks, bonds or other securities according to investment objectives. So every mutual fund scheme has a specific objective. So you invest in a scheme if you like the objectives, if you think those objectives match your objectives, and then the fund manager is supposed to make investments in line with those objectives. The net income earned in capital appreciation or investment after charging initial and ongoing expenses is shared among unit holders in proportion to the units owned by them. So once the investment is made, the gains that are made, the capital gains that are made or the dividends that are received are distributed among the shareholders. The capital gain is not necessarily distributed, but increases the overall value of the asset, and the overall value of the asset under management that is increased is owned by all the unit holders in proportion to the number of units that they hold. So if let's say initially you invested 5,000 rupees, later on it became 6,000 rupees. Let's say there are 10 investors. Each investor is holding 50 units. Each unit is 10 rupees. So 10 investor, 50 units, face value per unit. So if you multiply these three, you get the original investment. This original investment, let's say, grows in value to 6,000 rupees. So the number of investors count is same, number of units count is same. Now this face value, which was originally at 10, continues to remain at 10. The face value remains at 10, but the market value of that particular unit has gone up. It goes up by 6,000 divided by 10 divided by 50, which basically gives you 12 rupees. So 10 rupees of face value has become 12 rupees of market value now. So that is how actually all the investors earn money, or all the mutual fund investors who hold the units, worth of their particular investment actually increases as the NAV. What is NAV? We will discuss later, but that is how their value increases. Now what are various ways of classifying? You can classify mutual funds based on functional classification, portfolio classification or ownership classification. That is, what are the various categories of mutual fund is also determined by the way in which you classify. Now the first one is functional classification. Functional has open-ended funds, closed-ended funds and interval schemes. What are open-ended funds? These are funds in which investors can make or redeem investments anytime, directly transacting with the fund house. So invest money, you give money to HDFC invests it, and whenever you don't want the money, you go and ask HDFC gives you back your money at current market value. They are not listed on any stock exchange. Because you are directly dealing with HDFC or similar such any other mutual fund, there is no requirement for the units being listed on any stock exchange. On fresh purchases by investor, money flows into the mutual fund. So whenever a new mutual fund investor wishes, or whenever a new investor wishes to invest in the mutual fund, the money directly flows to the fund house directly. And good funds attract new investments. So let's say HDFC has a scheme. called HDFC Top 100 scheme. It's a very famous scheme. So if you invest money in that particular scheme, it's an open-ended fund. So if you are buying that particular scheme today, whatever is the NAV of that particular scheme today, you invest it at that price. But when the particular fund, or rather when that particular scheme was started long ago, sometimes in 2000, the issue price was 10 rupees, which is the face value. But today the NAV has grown, and we as new investors, when we invest at current NAV. Then you have something called as closed-ended funds. What are closed-ended funds? Closed-ended funds are opposite of open-ended funds. Investors cannot make or redeem the investments anytime. The fund manager can keep the investments till the end of the tenure. So each fund has a specific tenure. You invest in that particular fund, the money is locked for that tenure. SEBI, in order to provide liquidity to investors, has permitted listing of mutual funds of schemes on stock exchange. So these closed-ended funds, since you cannot sell it back to the mutual fund house, or rather mutual fund house does not redeem these funds till the date of maturity, what you can do is instead you can sell it to other investors. You can sell it to other investors, and the way you sell it is by you go and sell it in a stock exchange where these closed-ended schemes are listed. Prices at which this scheme is listed in the stock exchange may not be the underlying value of the investment NAV. However, even ideally, in an ideal scenario, the NAV or the net asset value or the correct market value of each unit ideally should be what should be the price at which it is traded in a stock exchange. However, stock exchange, the trading happens based on liquidity or based on information that is available. So in case enough liquidity is not available, this particular price, the NAV, as well as the price at which it is trading on the stock exchange may not be the same, right? And if investors purchase unit from exchanges, money flows to the selling investor and not the mutual fund. Obviously, when you are buying and selling between two individuals, the money does not go to the mutual fund when you buy or sell a closed-ended scheme. And fresh investments cannot be made into a fund. So once a closed-ended fund scheme is launched and the initial investment period is done, no fresh investments are allowed into a closed-ended fund. Then you have something called as interval schemes. What are these interval schemes? Interval schemes are a mix of open-ended and closed-ended schemes. They are closed-ended schemes having liquidity just like open-ended schemes, where investments and withdrawals are permitted at periodic intervals. It is not listed on the stock exchange, does not have a maturity period. So the key thing is, it is a mix or a hybrid of open and closed-ended, and they are not listed on a stock exchange, but periodic fresh investments as well as withdrawals are permitted. Then you have something called as equity funds. So this is functional classification. Now you can come to portfolio classification. What is portfolio? You have equity, debt and special. What are equity scheme or equity funds? Equity funds invest in equities that are multiple types, like growth funds, aggressive funds and income funds. Growth funds, they are best known for long-term investments as they provide long-term appreciation on investment. So your basic idea is you want to grow. The value of the investment that you make is expected to grow. So you are waiting for capital appreciation rather than actually monthly income. Then you have aggressive funds. These aim for higher than normal returns and hence invest in risky securities such as startup IPOs, speculative shares, etc. Investors who can take risk can opt for this. Aggressive equity fund basically invest in risky company shares. Then you have something called as income funds. These invest in safe securities paying high dividend and high yield money market instruments. So they invest in equities as well as money market instruments which have high yield. Investors seeking periodical return prefer them. Obviously, there is someone who wants income, periodical income. Equity funds investments are subject to market risk and returns fluctuate based on investment in price of underlying shares. So all the equity funds market price depends on the prices of the underlying shares or underlying securities where they have actually invested. So these are equity funds. Then you have something called as debt fund, and of course then the special fund. What are debt funds? Debt funds also again you can categorize into multiple types: bond fund and gilt funds. Bond funds invest in fixed income securities markets like bonds, both government and corporate, and other debt securities. They are less volatile and less risky than stock markets. These funds provide regular income to investors, and investors often use bond funds to diversify their investment portfolio. So basically this particular bond fund manager invests in corporate bonds and government bonds. Is fairly safe because it's a debt instrument, you get periodic return, right? Then you have something called as gilt funds. Gilt funds are highly secure. When we say secure, the principal portion is secure. However, if you're planning to sell in between before the maturity, then there is some interest rate risk that you are subject to. But the gilt funds are primarily only government securities, whereas bond funds invest both in private sector bonds as well as government bonds. Now, coming next to what are the risks associated with debt funds. There are three kinds of risk: interest rate risk, credit risk and prepayment risk. Interest rate risk is there is a relationship between market value of the bond and the market interest rates. So, interest rates go up, price goes down, and interest rates go down, the market price of the bonds go up. So, that is one particular specific risk that you have, which is the downside risk when interest rates go up. Then you have credit risk. Of course, you don't have credit risk in government bonds or guild funds, but you have credit risk in when you invest in corporate bonds. So there is the risk of default in prepayment of principal or interest. If the companies in which a mutual fund is invested fails to repay principal or pay interest, investors lose money, obviously. Then you have something called prepayment risk. This risk is related to early prepayment of principal by the issuer of the bonds. This generally happens in case of falling interest rates, and the company which has already issued a bond at a higher interest rate issues a fresh bonds or lower rate of interest and exercise its right of early redemption of callable bond. We have discussed this in security valuation bond chapter. When the interest rates fall and the company has an option to make a fresh issue or refinance the existing bonds by calling these off and making a fresh issue of bonds, then the company will do so. When that happens, because of this particular repayment of that particular bond, the investor in the bond, in this case currently the mutual fund, receives cash flow early and it is not able to reinvest them at a higher rate. So you have this prepayment risk, which is a fairly high risk, especially when you are looking at corporate bonds. Right. So we have seen equity and debt based classification of portfolio based classification of mutual fund scheme. Now let us have a look at what are the kind of special funds under portfolio based classification. So friends, now let us look at what are these special schemes, special funds rather. What are special funds? So first one is something called an index fund. This is actually my favorite. Index funds. So every stock market has an index, right? In India it is Nifty and Sensex. Nifty for NSE, Sensex for BSE. And index funds mirror the stocks comprising the index based on the weight assigned in the index. These funds provide returns that are closer to market returns. So basically what you do is you invest in an index. So index comprises of various stocks in various weights, and I've shown you in actually my regular classes, I've actually computed the index for Nifty, if I'm not wrong, Nifty 50, by taking the weights of a particular stocks based on their free float market capitalization. So you can actually invest in all these stocks in the same proportion every day, keep on continuously rebalancing depending on where that particular stock price closes and what is its weight in the overall index. So by doing that, you basically mirror the market movements, or market in this case is Nifty 50 or Sensex. So that is actually the benchmark index. So you mirror the movements in the market. So you as an individual investor can put money in an index fund which is managed by a fund manager, and they manage this fund where they deploy money in all the shares that comprise the index called Nifty 50, and they invest the money in those shares in the same proportion as they are in that Nifty index. So that way you basically end up getting the market returns. It's a very, very useful thing, and I actually invest a lot of my money through index funds only. You can invest directly in Nifty 50, you can also invest in IT fund or PSU Nifty, or you have a Nifty Next 100. So there are a bunch of indices like that. Then you have something called as international funds. These are funds, a mutual fund located in India to raise money in India for investing globally. So you have PPFAS fund, you have a bunch of other funds where the funds raise money from people like you and me. They go and invest in stocks like Facebook, Apple, Amazon, Netflix and Google. Right, so it's a fancy word for all these companies. So a lot of funds in India have, or rather mutual funds in India have raised money to invest in global equities. Then you have something called as offshore fund. Offshore fund is a fund which is exactly ulta. It's a mutual fund located in India to raise money globally for investing in India. So you're based in India, but your investors are outside India. But then they give the money and then you invest it in India. Then you have something called as sector funds. These sector funds, they invest entire fund in a particular industry. Let's say you have a banking fund, real estate fund, right, or utility fund. Like that, you have multiple sector funds. If you want to get exposure to a specific sector, you should choose it. But typically the point of choosing a mutual fund is diversification. So sector funds at some point they were doing well, but more or less a lot of people actually now prefer more diversified funds. What are money market funds? These are liquid funds which predominantly invest in safer short-term securities like CPs, CDs, T-bills, G-Secs, etc. They are debt-oriented schemes with the object of preservation of capital, high liquidity and moderate income. These schemes are used mainly by institutions and individuals to park their surplus money for shorter periods of time. So these are liquid funds, basically invest in short-term commercial paper or short-term money market instruments like commercial paper, government securities, so on and so forth. These are used by people like you and me to maintain money. So instead of putting our money in fixed deposits where we may have a use after 1 month, 2 months, so on and so forth, you put the entire money in liquid funds. So when you put money in liquid funds, the funds are safe and at the same time you get a much better return than a 2-month fixed deposit. Then there is something called as fund of funds. What is a fund of fund? So this you put money in a fund and the fund invests all the money in another mutual fund. So, this in other mutual fund schemes. The concept is popular in markets. There are a number of mutual fund offerings, and choosing a suitable scheme is tough according to one's object. And choosing a scheme according to one's objective is tough. So, in this, the biggest problem in fund of funds is basically you have to incur management expenses, or the total expenses are incurred at two levels. One in the original fund, second in the investing fund. Now, what are these management expenses? We will come back. I will come back to it. It is explained much better. Then you have something called as a capital protection fund. What is a capital protection fund? It aims to protect the capital invested. These types of schemes are closed-ended because it aims to protect, listed on the exchange, and intended portfolio structure is required to be rated by a credit agency. Major portion of the fund is invested in highly rated debt instruments. The remaining portion is invested in equity or equity-related instruments to provide capital appreciation. So, you protect the capital and have some minor appreciation. You protect the capital by investing in debt, and you have appreciation by investing some portion in equity. It's a closed-ended fund, and it is listed on a stock exchange. Also, they take intended portfolio structure is required to be rated by a credit rating agency. Then you have something called as gold funds. What are these gold funds? Gold funds invest in gold, either physical or digital. These units represent the value of gold or gold-related instruments held in the scheme. Gold funds are generally in the form of exchange-rated funds and are listed on the stock exchange. Investors can participate in the gold market, bullion market without the need of physically buying gold. So, this is one more fund where people do invest. Instead of buying physical gold, you can actually invest in 1 gram of gold every month, and probably after 20 years or 15 years, when let's say there's a marriage at home or something like that, you actually have money locked in a gold fund which you can actually sell in the market and buy physical gold at that point of time. So, a lot of people do that, right? So, this is one particular fund where there's also an exchange traded component where this particular fund is listed on an exchange, and where you can actually buy the units of this particular fund directly on the exchange. Then you have something called as quant funds. Now, quant funds are recent phenomena. I won't say very recent, but especially in the last couple of decades, they've caught up very well. These funds are data driven, statistical, models where they create models where they look at factors that are influencing a particular stock price, and they make decisions, quick decisions, and invest in stocks and then come out of stocks very quickly. So, these funds rely on automated programs that help in decision making, and the investment as well as timing and action in decision making for the quantum of investment as well as its timing and action, everything, and the concerned manager must only act accordingly, like an active manager who selects the quantity, price of share, and timing of investment. So, in a quant fund, the program decides. In quant funds, manager focus on robustness of the model. The manager is more focused on whether the model is correct, whether the model is tested enough, what happens to the model in unforeseen scenarios, so on and so forth. The quant fund manager is different from index fund manager, because in index fund manager, hands off the investment decision purely on a concerned index. If index composition changes, the index fund manager only changes the composition of their portfolio. If the one particular stock moves up, you increase weight of that stock. Like that is what an index manager does. So basically, it's a passive management strategy. Whereas in a quant fund, the manager decides and monitors and makes decisions based on the outcome. So, quant fund manager basically goes through the program. Is the program giving good results? Is it considering all data? Is it taking right decisions? So, they focus more on optimizing the program. The prime advantage of a quant fund is that it eliminates the bias of humans and subjectivity by using model-based approach. And since a quant fund normally follows passive strategy, their expense ratio tends to be lower than actively managed mutual fund schemes. So, even a quant fund is passively managed. However, quant funds are tested based on historical data, and past trends cannot altogether be ignored, but can also be used blindly as good indicators. So, you cannot say that everything that has happened in the past will repeat. If that were the case, all of us could actually see the future. So, quant funds, just by creating a model based on past data, do not necessarily always make great money by following simply the model. The model has to be fine-tuned constantly and optimized constantly. What are balance funds? Balance funds make the investment in both debt as well as equities. The debt portfolio of the scheme provides stable return with lower risk, and the equity portfolio provides higher return with higher risk. Such funds provide moderate returns to investors, as investors are neither taking too much risk or too low risk. It's a balanced fund. Generally, I don't believe people should invest in balanced fund. If you want safe money, put it in debt. If you want slightly better returns, go into equity. But anyway, that is individual choice. I am not making any financial suggestions here, financial investment suggestions here. Then you have equity diversified funds. Diversified funds invest in a wide array of stocks where fund manager ensures a high level of diversification in holdings, thereby reducing the amount of risk in the fund. Flexi or multi-cap funds or contra funds, index funds, dividend yield funds, etc. are equity diversified funds. So basically, you diversify yourself extensively. Then you have flexi cap or multi-cap. Investments are made in small cap, mid cap and large cap. So you have three kinds of stocks: small cap, mid cap and large cap. Large cap means which has large capitalization. So huge company like HDFC, Infosys, TCS. Mid cap means something which has slightly lower, probably around 8,000 crores, 10,000 crores. Small cap is probably 1,000 crores, 1500, 2000 crores. Flexi cap or a multi-cap fund invests across all three kinds of stocks, large cap, mid cap and small cap, depending on what they see as the direction of the market. And of course, they have to follow the limits that are given in the documents that are filed at the time of issue. So basically they will say, I will not invest more than 50% in either in large cap, mid cap or small cap. I will invest at minimum 10% in each of those. So they have to follow those limits. Then you have something called as contra funds. These invest in those out of favor companies that have unrecognized value. Investors who invest in contra funds have an aggressive risk appetite and expect much higher returns. So exactly opposite. They do ulta. If market is saying sell this stock, they will go and buy that stock. Then there is an index fund. I explained to you what is an index fund. It mirrors the performance of an index, and the fund maintains portfolio of all securities in the same proportion as stated in the benchmark index. Key point to note here is the fund maintains portfolio of all securities in the same proportion as stated in the benchmark index and earns almost the same return as earned by the market, subject to tracking error. What is this tracking error? We'll come to it. I think it is somewhere towards the end. Please remember this concept of tracking error when we come there. Then you have something called as a dividend yield fund. What is a dividend yield fund? Dividend yield fund invests in shares of companies having high dividend yield. What is a dividend yield? Dividend yield is dividend per share divided by current market price. Simple. Right. Most of these funds invest in stocks of companies having dividend yield higher than the yield of a particular index, and the price of these stocks are generally less volatile than growth stocks. So these are basically value stocks and offer growth potential. Among diversified equity funds, dividend yield funds are medium risk proposition, but these funds have not always proved resilient in short term corrective phases. So these funds do well in medium term and long term, and not necessarily in the short term. There are two options for earning income from mutual fund schemes. So there are two kinds of way in which you earn income. One is capital appreciation or growth appreciation or cumulative option. So when you invest money in a mutual fund, you basically, the mutual funds can declare a dividend. They declare a dividend out of the cash that they have with them or out of the dividend proceeds that they receive from the company, so on and so forth. If you say that if you choose the growth or cumulative option, you basically are saying, please invest back any surplus cash that you get because of dividends back into the overall portfolio. Don't give me any money. So that is basically a growth option. Then you have something called as a dividend option. That is, no, periodically give me some dividend. There also you again have two options, which is you please give me the dividend in cash. That is, you transfer that dividend to me to my bank account, or with that dividend, whatever you have, you buy fresh units of your own scheme. So the dividend, whatever is given to me, with that you yourself, the mutual fund scheme themselves should buy fresh units of the same scheme. So that is called as dividend reinvestment option. The dividends are reinvested. How do you understand these three things? How do you understand the difference between dividend reinvestment and growth option? There is a very simple example. Let's say they initially invested 50,000 in both of them and at 10 rupees per unit. So basically 5,000 units. At the end of the year, let's say this 10 rupees is increased to 15 rupees. That is because appreciation in this 50,000 was invested in multiple shares. The shares value grew. So the overall assets under management grew. What is assets under management? The value of the portfolio on the day when which you are measuring the portfolio. Initial issue is 50,000, but when you invested in 10 shares, some shares went up, some shares went down. The overall portfolio value, let's say now is 70,000, 75,000. So if it is 75,000, for same 5,000 units, the value the NAV per unit is about 15 rupees per unit. Now this 15 rupees, let's say the mutual fund company decides that they also want to pay some dividend of 2 rupees per unit. So if you pay dividend of 2 rupees per unit, it comes to 10,000. In a dividend reinvestment option, this 10,000 goes out of this market value of this 75,000. So initially it was 50k, that increased to 75k. 75k divided by 5k is 15. So out of this 75k, you are paying off 10,000. So you are left with 65k. So this 65k divided by 5k will make your NAV as 13 rupees. Or you can think of it as 15 rupees NAV minus 2 rupees dividend, which basically is 13 rupees. Now this 2 rupees of dividend is reinvested back. So 2 rupees of dividend into 5,000 units is 10,000. So 10,000 by 13, you basically get 769 new units. So the dividend is reinvested back in the same scheme. Here in the growth option, there is no dividend concept itself. So the NAV is directly at 15. The value of that particular scheme is 15 into 5,000 is 75,000. Whereas here, the number of units has increased. The number of units has increased and the NAV has decreased. So the units is 5769.23 and NAV is 13. You multiply both, you get 75,000 approximately. However, in a dividend reinvestment option, you always have the issue of taxability. So when a dividend is declared, there could be tax implications. Then you have something called as an equity linked savings scheme. So ELSS have a lock-in period as prescribed by Income Tax Act. So So income tax under various sections under chapter 6A, they actually give you deductions for investment making in for investments made under ELSS. So it has potential to give better returns than traditional tax saving schemes and provides options for investors to save tax under section 80C or relevant section. These sections have changed. Now it is 80CC, subsection something and so on and so forth. Investing in ELSS through a SIP can help investors to average the cost of holdings, and SIPs also reduce the burden of one-time outflow. SIP is systematic investment plan. So you systematically every month you buy something. That is called as a systematic investment plan. There is something called systematic withdrawal plan. That is every month systematically you sell 100 units of the mutual fund scheme that you hold. So you can have both SIP or SWP. Then there are sector funds. We discussed about this. These sector funds focus on a particular industry. They enable them to take advantage of industrial cycles, and they ride on market cycles that have potential to offer good returns if the timing is perfect. However, they lack the downside risk protection available in diversified funds. These should constitute only a limited portion of one's portfolio, as they are much riskier than a diversified fund. Then you have something called as thematic funds. Now, what are these thematic funds? A thematic fund focuses on trends that are likely to result in outperformance by a certain sector or company. These themes could vary from multi-sector, international exposure, commodity exposure, and unlike a sector fund, the thematic funds have a broader outlook. However, the downside is the market may take a longer time to recognize the views of the fund house with regard to a particular theme, which forms the basis of launching a fund. So, unlike a sector fund where you're choosing specifically a sector, a thematic fund is basically you choose a theme. Let's say infrastructure. So, Indian infrastructure is going to grow. So, what are the stocks that could be linked? So, I will go and purchase stocks which do well. So, I will purchase top 3 cement companies. I will purchase top 3 tractor companies. I will purchase top 3 truck companies. I'll purchase top 3 cable companies. So like that. So you take decision based on a certain theme. Whereas sector is you choose only cement sector, you invest all the money in cement sector. Right? There's a difference between those two. And the problem in this particular thematic funds only is that even though you may have a theme, you may have a belief in a theme, that theme may take actual longer time to play out in real life. Then you have something called as an arbitrage fund. An arbitrage fund seeks to capitalize the price differential between two markets, generally spot and futures. It aims to generate low volatility returns by investing in a mix of cash equities, derivatives and debt markets. The fund seeks to provide better returns than typical debt instruments and lower volatility in compared to equity. The fund is aimed at an investor who seeks the returns of small saving instruments, safety of bank deposits, tax benefit of RBI bonds and liquidity of a mutual fund. So basically an arbitrage fund invests in a mix of cash, equities, equity derivatives and debt market. So it basically uses all of these, and it is expected to be slightly volatile because it doesn't go overboard on equity derivatives, but at the same time it is well balanced out across all these. So it tries to capture opportunities, because even in derivatives it does not do the open positions. They basically try to capture the arbitrage between the two specific markets, spot market versus future market, and try and generate money out of that. What are hedge funds? Hedging is actually a practice of attempting to reduce risk, but the goal of most hedge funds is to actually maximize return on investment and not necessarily hedge. Hedge funds are mutual funds that they collect money, but they act as a private investment vehicle, and they invest in a mix of debt, equity, commodities, variety of financial instruments, and their goal is only to maximize return. Hedge funds are actually not allowed in India at all. They are most of them operate out of US, and some of them operate out of all these tax havens like Cayman Islands, so on and so forth. But the basic idea is all these hedge funds are there to pool money from knowledgeable high net worth individuals or investors, and then they invest them using multiple strategies to generate much higher return. They're just like mutual funds only because they pool the money. Beyond that, there's no similarity, because mutual funds are actually subject to a lot of regulation. Hedge funds regulations are very light. Okay, anyone who's actually investing in a hedge fund is not necessarily, looking to minimize risk. They are actually looking to maximize the return. And they invest aggressively across financial instruments. They cannot be started in India, but foreign hedge funds can definitely invest in India. The big difference between a hedge fund and mutual fund is that former does not reveal anything about its operations publicly and charges a performance fee. Typically, if it outperforms the benchmark, it takes a share in profit. So they follow this 2/20 rule, where they take 2% of annual assets under management as annual fee, and 20% of the overall profits are taken by them. That is what they do in hedge funds. In mutual funds, no. You have a certain expense ratio, you have to meet within that. Your expenses have to be within that ratio. Then you have something called as cash fund. Cash fund is an open-ended liquid scheme that aims to generate return with lower volatility and higher liquidity through a portfolio of debt and money market instruments. The fund has retail, institutional and super institutional plan, each plan offering growth and dividend options. Basically, you invest only, it is not cash. When you say cash, it is equivalent to cash, right? So, they invest in debt, money market instruments, and please don't know equity. Okay. What is an exchange traded fund and what are its types? So this is one important thing. Exchange traded fund can be bought and sold like any other stock on a stock exchange. The quoted price are expected to be closer to the NAV at the end of the day. And types of ETFs. You have index ETFs, which I was telling you about. You can have Nifty index ETFs, so on and so forth. Commodity ETF, they invest in commodities such as precious metals. Bond ETFs, the exchange traded funds invest in bonds known as bond ETFs. Currency ETFs, they deal in currency. Investors can invest in currency indirectly through these ETFs. So basically, these are mutual funds where you pool the money. The money is actually invested in a specific asset or asset class, and the value of the asset, when I say asset, you think of it as Nifty or think of it as gold or think of it as your other commodity. The total value of that particular commodity at the end of the day reflects in the price of this particular ETF. So NAV and the ETF price are expected to be very close, but usually they may not be close because of various issues of balancing, weightage, and so on and so forth. Then you have something called as fixed maturity plans. What are these fixed maturity plans? Fixed maturity plans are close-ended mutual funds in which an investor can invest during a new fund offer. They have a fixed tenure and a maturity date. They invest in CDs, certificates of deposit, commercial papers, CPs, money market instruments, and NCDs over fixed investment period. They are traded on a stock exchange. The main advantage of this is they are free from any interest rate risk because they invest in debt instruments that have same maturity as the fund. So you take a fund for 1 year, you launch a fund for 1 year, you pool the money from all the investors, you invest the entire money in bonds that have 1 year maturity. Okay, so that you do, however, they carry credit risk as there is a possibility of default by debt issuing companies. The only risk that they face is actually the credit risk and not necessarily the actual interest rate risk or any change in price due to changes in market conditions. So if credit rating of an instrument is downgraded, the returns of an FMP can also come down. So if you also have this issue of price coming down because of change in credit rating, obviously then the even if the maturity, even if you have invested till the maturity date, if the particular company's debt is actually going to become worthless because of downgrade in credit rating, then you may as well sell it off in the market, in which case you will actually make a loss. Then you have what are the advantages of mutual fund? After having understood so many things about mutual funds, various types of schemes, so on and so forth, what are the advantages of mutual fund? Professional management. Mutual funds are managed by skilled professionals. They offer diversification. So you can actually, what you cannot do on your own, you can actually put it in a mutual fund and diversify, which reduces risk and increases returns. It is very, very convenient to administer and low management costs. There are no administrative risks of share transfer. Many of the mutual funds offer service online which save investor time, and investors have no administrative costs other than specific charges. Any extra cost of management is to be borne by the AMC. Basically, it is very convenient. You and I can invest it very, very simply. Higher returns. Over a medium to long term investment, investors generally get higher returns in mutual fund as compared to other avenues. Liquidity. All open-ended schemes, liquidity is provided directly by the sales or repurchase of mutual fund. In case of closed-ended, liquidity is provided wherein you can sell it in stock exchange. If you invest in, let's say, real estate, very, very little liquidity. Whereas if you look at mutual fund, there is very high liquidity. Highly regulated. In India, all funds are registered with SEBI and are very, very strictly regulated as per mutual fund regulations, which provide excellent investor protection. And SEBI regulations now compel all mutual funds to disclose their portfolio on periodic basis. NAVs are calculated on a daily basis in case of open-end funds and are available online. So all information is available online. Then they also give you flexibility. We can opt for a SIP, SWP, as I was telling you, and plan the cash flow requirements as per your convenience. Then economies of scale. Pooled money from several investors ensures that mutual funds enjoy economy of scale. It is cheaper compared to investing directly in the capital market, which involves higher charge. That is, if you do research, you have to do independent research, you have to figure out everything, and like that 20 people have to do research. Rather, all of you pool money, give it to one guy, and that person basically does the research and makes investment decisions, and that person is also an expert. Then convenience. One can invest in mutual fund scheme very easily using mobile apps through on mutual fund company websites, sitting at home, and also monitor their performance completely online. The convenience levels are very, very high. All of us invest through mobile apps. Right. So these are the advantages of mutual fund. Now, what are the disadvantages or drawbacks of mutual fund? This is also a very important question. There is no guarantee of return. Even though historically a lot of funds have made money, there is no guarantee. They do not generate great returns. Quite a few of them generate below par returns. There may be some who may underperform the benchmark also. It may be possible that where markets have risen and mutual fund schemes increase in value, but the investor would have got the same increase had he invested on his own. So sometimes that expert may not be doing a great job. You may get the same kind of return if you were to handle it on your own. Unethical practices. Mutual funds may not play a fair game. Sometimes manager may sell some of their holdings to sister concerns for substantial notional gains, showing higher NAVs. So managers also do all this in between tamasha where they do selling between sister concerns so that they can show inflated NAVs and all. So this has happened. There are sometimes even front running and all of that. There was a case where Axis Mutual Fund employee did something and it was caught by the SEBI. Diversification. A mutual fund helps to create a diversified portfolio. However, though diversification minimizes risk, it does not maximize return. The returns that mutual fund offer may be less than what an investor can achieve. For example, single security held by mutual fund doubles in value. Mutual fund itself would not double in value because security is only a small part. By holding different investment, mutual fund tends to neither exceptionally well nor exceptionally poor. So, because you have diversified so much, because of this diversification, you don't do either very well nor very bad. So, you don't take decisions of doubling down the investment, so on and so forth. Right. So, you do reasonably okay. Then selection of proper scheme. It may be easier to select the right share rather than the right fund. There are infinite number, there are huge number of funds and schemes. So, it has become now a very, very difficult task to choose a scheme. For stocks, one can base a selection on the parameters of the economic industry and company. In case of mutual funds, past performance is the only criteria, but which cannot predict the future. So, in case of company, you can actually do analysis of company, but in case of mutual fund, you can't, because mutual funds investment composition changes, and only the past performance and the fund manager are the two criteria available for you to take a decision on investing in a mutual fund. Then taxes. Making decision about investor money, mutual fund managers not consider personal tax situation. So, I've explained to you about the dividend reinvestment philosophy. That would be a tax issue. Then whenever there is a sale of any particular stock, there could be capital gains that could be arising from mutual fund. Then transfer difficulties. Complication arise in mutual funds when a managed portfolio is switched to a different financial firm. Sometimes mutual fund position must be closed out before the transfer can happen. This can be a major problem for investors. Liquidating a mutual fund portfolio may increase risk, increase fees and commissions, and create capital gains taxes. Sometimes there will be transfer issues also, but these days these have come down largely. These days we don't see any transfer issues. Earlier, quite some time ago, that was there. Then we come to the concept of NAV, which I have been using a lot. NAV, or net asset value, represents the market value of total assets of the fund reduced by total liabilities attributable to those assets. It is computed on a per unit basis. That is, dividing the net asset value by number of outstanding units. It is the amount at which a unit holder would receive if the mutual fund were to be wound up today. So, net assets of the scheme divided by number of units outstanding. So, net assets of the scheme is market value of all investments plus any receivables, any money that you have to receive from somebody when you have sold and money is yet to be received, accrued income, so dividend that is declared but not yet received, other assets, any other assets that the mutual fund holds in terms of FDs or cash or temporary investments in liquid funds, and accrued expenses, any expenses that you have to pay with respect to distribution, management, technology, software, so on and so forth, and all other payables that are there for your employee salary, so on and so forth. Like that, all put together, you take all pluses and all minus and adjust everything and look at the net asset value of a particular scheme. Right. Then you have something called as entry and exit loads. What are these? Some asset management companies have sales charges, entry load or exit load, to compensate for distribution costs. Entry and exit load in mutual funds are charges one pays while buying and selling the fund. Entry load is charged at the time of investor purchase units of a scheme. It is percentage added to the prevailing NAV at the time of allotment. Exit load is charged at the time of redemption. The exit load is deducted from the NAV at the time of redemption. So, mutual funds schemes typically also have something called as a load, exit and entry load, because the mutual fund charges, or rather a mutual fund has some additional charges with respect to any new investor that is coming in, or where it has to handle a new investor and not who's investing not at the time of the initial offering, but subsequently in between they levy something called as an entry load. So, anyone coming up in between has to pay this entry load. Now, this entry load, there are regulations of SEBI again, they have come down substantially, but then the concept of entry load is still valid. Then you have something called as exit load. What is an exit load? Exit load is when you are redeeming. So, typically you don't want investors to redeem very quickly. You don't want investors to suck out all the liquidity from the fund. So, what you do is you levy something called as an exit load. Whenever you sell, let's say you sell within the first 3 years, first 5 years, we will levy an exit load. The load is, let's say, 1%, 0.5%, 2%, something like that. So, that ensures that people stay invested in the fund rather than trying to keep buying and selling constantly. But again, these both entry and exit load amounts have substantially come down in the market after SEBI's intervention. Then we come to something called as trail commission. We discussed about trail commission. I was telling you that there is something called as trail commission. It is an amount that a mutual fund investor pays for his advisor each year. The purpose of charging the commission to investors is to provide incentive to the advisor to review the customer's holdings and give advice. Distributors usually charge a trail commission of 0.3 to 0.75% of the value of the investment of each year. The investor's money remain invested with the company. This is separate from any upfront commission that is usually paid by the fund company to the distributor out of its own pocket. So, now the key thing you have to note is there are two kinds of plans called direct plan and regular plan. Regular plan, you actually have an advisor. So, this advisor is paid some amount, which is typically between 0.3 to 0.75 every year from your funds, and the distributor is paid. And whereas if you invest in a direct plan, that is, you invest directly with the company without going through any distributor. And when I say company, the mutual fund asset management company, you directly invest in the through the asset management company by going to their website or selecting a direct scheme. This particular commission is not there, and this, when it is compounded, actually is a very, very significant amount. So most of the people who are financially aware, who are financially educated, they invest directly in direct plans instead of going for regular plans. And the commission that is paid to the distributor is known as trail commission. Then there is something called as expense ratio. I told you we will discuss about this as well. What is expense ratio? It is also referred to as management expense ratio or TER, total expense ratio. It is the percentage of assets that are spent on running a mutual fund scheme. It includes expenses like management and advisory fees, travel costs, consultancy fee. Expense ratio does not include brokerage costs for trading the portfolio. Paying close attention to the expense ratio is necessary. The reason is it can sometimes be as high as 2 to 3%, which can undermine the performance of a mutual fund. So sometimes the asset management companies, when they don't play fair, they charge very high expense fees. Now SEBI has come out very, very clearly trying to restrict the expense TER or expense ratio or management expense ratio that funds can levy. Especially in very, very large schemes, they reduce this substantially because there are not many expenses. Your cost of distribution is minimal. You have people coming up and investing in your scheme directly. So the expenses actually tend to come down with economies of scale. So the SEBI actually lays down slabs very, very clearly what is the expense ratio that actually can be charged to a particular scheme. So if you see, you have something called as trail commission, you have something called expense ratio. These two are money is taken away from the money that you have invested and that is given off to different people for managing your funds. One to the AMC company, asset management company, for managing your money, one to the distributor who is actually helping you decide which fund to invest or which scheme to invest. Then coming to the next one, what is side pocketing? This is a very, very important past exam question. So what is the side pocketing? Side pocketing is an important question. It's also has been asked in the exam once. Side pocketing in mutual fund leads to separation of risky assets from other good investments and cash holding. This is done to make sure that the money invested in a mutual fund which is linked to a stressed asset gets locked until the fund recovers the money from the company or could avoid distress selling of illiquid securities. Whenever the rating of a mutual fund falls, the fund can shift illiquid assets into a side pocket with an independent NAV so that there is no undue pressure on the redemption of its better rated liquid assets of the scheme. Consequently, the net asset value of the scheme will reflect like the actual value of the liquid assets. Side pocketing is beneficial for those investors who wish to hold onto the units of the main fund for a long term. So basically, if let's say you have 100 rupees of assets, right? I am referring to a single portfolio which has 100 rupees. In this, let's say there is 90 invested in good and 10 invested in bad. Now everybody, once all the investors know that the 10 is gone bad, everybody rushes to withdraw their money from the fund. So you and I hold probably 1 rupee, 2 rupee, 3 rupees. But when we hold this 1 rupee, 2 rupees, 3 rupees and we want the money back, the company has to redeem this money from this. The company has to sell some good stocks from this 90 and pay us the money. So there could be redemption pressure. So what they do is whenever they find out such kind of an issue where they split the NAV. So the NAV, if the total assets of that particular scheme, let's say is 100, they will split it into two parts of 90 and 10 and they will issue separate NAV for this and separate NAV for this. And this is locked. You cannot withdraw for a certain period of time or till the issue is settled. So such kind of things happen, especially in case of Franklin Templeton. It has actually happened where they invested in Island FS and so on and so forth. It's a very interesting case. Go and check it out on Google sometime. Then there is something called tracking error. What is tracking error? It can be defined as the deviation of a fund's return from the benchmark return. So how much are you supposed to return versus your benchmark? Although the fund manager designed the investment strategy to generate returns of an index, it often may not exactly replicate the index. The tracking error can be calculated based on corresponding benchmark return vis-a-vis quarterly or monthly average NAVs. Higher the tracking error, higher is the risk profile of the fund. Whether the fund outperforms or underperforms their benchmark indices, it clearly indicates that of the fund managers are not able to generate returns provided by the index. Other examples for tracking errors are transaction costs, fees charged by AMCs, fund expense, cash holding. The fund can replicate an index, that tracking error ideally would be zero. Tracking error is calculated as differential return minus mean of differential return whole square, sum of all differential returns by n minus 1. So basically this is your standard deviation formula. Standard deviation where you have a sample, so which is by n minus 1. Right. So standard deviation of all the deviation minus. So every day you would see the deviation between the NAV, every day you see the deviation in the return of the fund versus the index that it is tracking, and you take daily deviations and then you compute the average of deviations, daily deviation minus average of deviation whole square, sum all of it, divide by n-1 and do a square root of it. So basically this is a standard deviation formula, right? And here please note one thing, very, very important that you have to note here. The deviation can not only happen because of difference in investment styles. Let's say you are investing in, your benchmark is Nifty 50, but let's say you have chosen to invest in only 20 stocks out of Nifty. Obviously, there will be a difference in the return, but please note, that is a very clearly explainable difference. There are also other explainable differences, because when we as investors invest in a mutual fund, the mutual fund also has to survive out of the return that is generated by making our money as investments. So, let's say we invest 100, this 100 grows to 110. Out of this 10, the mutual fund company takes 1 and only 9 is given to us. So, the return of this particular on our investment is 9%, whereas the benchmark may be giving 10%. Right. So, like that is what they are basically saying here. They are saying that transaction cost, basically the brokerage cost and so on and so forth, fee charged by MC, basically this 1 rupee, which is the total expense or whatever it is, fund expense, cash holding. So, the fund may not invest the entire amount in all the equities or shares or whatever securities. They may keep some money in cash for meeting any redemption requirement. So, to that extent, the funds always will have some cash on which they will never earn any return, which is why there is always a tracking error for every scheme. What is dividend equalization reserve? Now, this is a very interesting concept, and when you solve a problem is when you will understand, but I will explain to you what this is. A dividend equalization reserve is, in an open-ended scheme, mutual fund investor can make entry and exit whenever they want. Right? New investors buy mutual fund units between any 2 distribution periods are not entitled to any share of income of the scheme which accrued before they bought the unit. So, if let's say there is any income that is generated by a mutual fund scheme which is distributed to all its unit holders, that income accrues to the people who were holding the units through the period, or people who were holding the units as on that particular day. So, it does not accrue to the people who come and join after it. So, what mutual funds usually do is, to the people who are subsequently joining, they add to the extent of the total gain that is made till that day, that amount they divide by the total number of units that are there till that day, and that per unit they arrive at a value which is added as a dividend equalization amount to the fresh issue of particular units. At the end of each distribution period, the mutual fund management allocates same amount of dividend from income of each fund to each unit, whether new or old. So you, let's say there is 100 of assets, 10 income is there. This is the portfolio, this is dividend that the portfolio has received. Now 10 is the income. This 10 is attributable to original unit holder. Suddenly one new unit holder joins. He says, I will put another 100. Now this 100, you cannot say that I will also be now eligible to the dividend. No, this 100 is taken. What they do is, they will say, out of this 100, we are going to allot you units in such a way that 90 goes here, or 91 goes here, and 9 goes here. So that you also get the same proportion of dividend as everybody else, but you have contributed for it because you came in between. Right. To compensate all investors for this anomaly, an equalization payment is added to the cost of units at the time of purchase. It is the amount of income that has arisen up to the date of purchase of the unit. Very simple. Total income that has arisen up to the date divided by the number of units is equal to per unit income. This amount is later effectively repaid to the purchaser at the time of a dividend distribution. So, you pay first 10 rupees, then you get back 11 rupees. This happens only for people who are investing in between, that is just in between 2 dividend declaration periods. Similarly, at the time of exit, the amount of income that has arisen up to the date of the repurchase of the units is added to the repurchase price to compensate the outgoing investor. So, this is someone coming in. So, let us say someone is redeeming in between. If somebody redeems in between, interest that is accrued till that date is also, income that is accrued till that date is also paid off to that investor who is leaving away in between. Alright. So, we will understand this when we solve a problem. Then, now, how does one evaluate mutual funds? Selection of mutual funds is important as its performance. Selection and performance evaluation both are important, and why one should evaluate performance mutual fund is for 3 reasons. To ensure the fund continues to generate maximum profits and minimum returns, performance is not up to the mark, then replacement decision is to be taken, and past performance is not necessarily a guarantee for future performance, which is why you need to evaluate. Since market is subject to fluctuations, evaluation of funds on daily basis is not possible. You should constantly look at it once in 6 to 12 months, but you should evaluate the total return over a 3 to 5 year period. Ideal way in which you evaluate performance is every 6 months, but the total return should be taken for last 3 years or 5 years. How do you evaluate a mutual fund? You have quantitative parameters, and you also have qualitative parameters. So, first let us look at quantitative parameters. You have risk adjusted return. Basically, you look at the risk that a fund is taken and adjust for the risk and look at the return. So if some fund is taking higher risk, are they getting higher returns or not? So that is basically the idea. So you take risk adjusted measures, a risk adjusted way of looking at the returns, then you compare it with benchmark returns. So every fund establishes a benchmark. So you can say I am a large cap fund, so my benchmark is Nifty 50. Compared to Nifty 50, how are my returns? Am I doing better? Am I doing not better? For example, equity funds are benchmarked to Sensex and Nifty. If during a particular period, index has provided 11%, whereas mutual fund has given 13%, then the 2% is alpha, right? Then the same fund has outperformed the benchmark. And similarly, if the fund has given only 8%, then it has underperformed. So this is negative alpha. Then comparison to peers. Similar to evaluating performance of mutual fund against benchmark, comparison of relative performance to other peers. Other people who are in the same, who have similar funds, you compare with them. A good mutual fund is supposed to consistently beat its peers in performance, only then it is worthwhile to hold it. Then you compare returns across different cycles. So a mutual fund, when you evaluate, you don't evaluate for a 6 month, you evaluate performance over 6 to 12 months, but then you also look at returns over 3 years, 5 years. Why? You're more bothered about how many cycles has it seen, what is the market cycles that have happened. In those cycles, how has it performed? How is its performance compared to various benchmarks and its peers? So you look at all of that and then take a decision whether this particular mutual fund has performed well or not. Then you also have financial measures. Financial measures, we have discussed about this expense ratio, and then we have discussed about this expense ratio, which is basically all the expenses that an AMC needs to meet, which are basically taken from the assets under management. Then you also have something called a Sharpe ratio. You remember Sharpe ratio from the portfolio management chapter, which is return on the portfolio minus risk-free rate by the standard deviation. Then you have something Trenner ratio, which is what again? Return on the portfolio minus risk-free rate divided by the beta of that particular portfolio. And finally, you have something called a Sortino ratio, which you are learning afresh now. This is basically return on the portfolio minus risk-free rate by the downside deviation. You are not doing total standard deviation, which is basically systematic and unsystematic risk, but you are taking only the standard deviation, which is on the downside. So you ignore all upside deviations and look only at downside deviations. It's a very different way of evaluating a mutual fund. And you compare it with other mutual funds and see which one is performing better. Then you have qualitative parameters. Some of the qualitative parameters, the quality of the portfolio. Basically, what are the kind of stocks that you have? Basically, do you have large blue chips, large caps, small caps? Whether they are value, whether they are growth, whether they are debt. Especially in case of debt funds, you look what is the credit quality, what is the maturity, and so on and so forth. You look at various such factors. Not only that is necessary that mutual funds should hold good quality stocks, but it's also necessary the investment should be as per the objectives of the initial fund. Under normal circumstances, a fund having lower turnover, portfolio turnover ratio is better. That is, a fund that is constantly buying and selling typically, is not necessarily treated as a good fund. It is basically poor way of doing business. Then track record and competence of the fund manager. Fund managers are the ones who are running the entire fund or managing the entire fund. They are the ones who select securities. The competence of a fund manager is very, very important in their past experience as well. Credibility of the fund house team of fund house also plays a big role towards investors' interest. In addition to investment decisions, there are some other administrative tasks such as redemption of units, crediting of dividend, which play a crucial role in qualitative assessment of a mutual fund house. So basically, what administrative tasks are they doing properly? Are you communicating properly? Are you giving information properly? Are your redemption proceeds coming properly? Is new information coming out properly? Is your expense ratio being clearly disclosed? All of these are also qualitative factors. Then, what is the role of fund managers in mutual funds? A portfolio manager who manages an individual fund is very, very like a portfolio manager, right? A fund manager is gatekeeper of funds of any mutual fund. So they are responsible for huge amounts of money. Today, mutual funds manage some 40-50 lakh crores. 40 or 50 lakh crores of all our investor money is managed by mutual funds. So we have to be very, very careful. While main responsibility is to ensure good performance of a fund that he or she is managing, there are other roles as well. And these roles change based on active or passive funds. Now, what is an active fund? In an active fund, basically the fund manager takes decisions. He is not benchmarked, he is not following an index. He tries to beat an index by doing active management of buying and selling securities. Fund manager's role in these funds is more crucial, as though use of his extensive research, judgment and due diligence, he has to outperform the market and generate a positive alpha. Right stock picking can help them. In passive funds, contrary to active funds where there is, where you don't do everyday buy and sell other than to maintain the page, fund manager's role is to match the return of the underlying index with the minimum tracking error. The role is very different. In active, you have to generate an alpha. In passive, you have to have minimum tracking error. In addition to all these roles, following are the additional roles. Compliances. Mutual fund managers have enormous number of compliances. It's SEBI, AMFI, then they have reporting of expense ratio, redemptions. They have to make investor awareness. Then they have to ensure that all documents are received on time. Then they have to constantly monitor the performance of the fund. Every day they have to monitor, morning, afternoon, evening. They have to constantly monitor the fund. The role of a fund manager does not invest selection of securities for investment, but has to evaluate them on a continuous basis. It is a mutual fund manager's decision to enter or exit market that maximizes the wealth of unit holders. The performance of a fund manager not only judged on the base of return but also on the growth achieved above inflation. Because when we invest in a fund, let's say the inflation rate is 5% and our fund gives only 6%, we have not beaten inflation. The value of money is not significantly gone up. We are not actually generating any great returns, right? So they have to constantly monitor and they have to ensure that they generate returns that are higher than inflation rates or higher than even FD interest rate. Right, then their goal is wealth creation and protection. This role can be considered as very, very fundamental. Wealth creation is very important, but reckless risk also should be avoided. Investment should be made after thorough research of both fundamental and technical analysis portions. Control over works outsourced to third parties. So in a lot of cases, you have a lot of third parties also involved, like distributors. Then you have people who manage back office functions, then technology functions, then all that communication functions and all of that. All those third parties also you should have control over to ensure that the funds are managed properly and the investors are communicated to properly. What is the role of FIs in mutual funds? FIs basically is foreign institutional investors. Mutual funds are DIs, domestic institutional investors. FIs are people abroad, outside India, who invest in India. FIs can invest directly in stocks. They can also invest in mutual funds directly. They are registered abroad with a view to investing in other nations, in equity markets, hedge funds, pension funds, mutual funds. They can invest in mutual funds or they can directly invest in stocks. They have strong research teams which guide them to invest in a country with the possibility of strong return. They are important source of capital in any economy, especially in developing economies. Normally, FIs feel a bullish market for a short period of time and hence a nation experiences strong inflow of foreign currency in its financial system at that time. So basically, when FIs invest, suddenly they put in a lot of money. So, at some point of time in Indian markets, whenever FIs used to invest, Nifty used to go up, rupee used to appreciate. It was a very, very standard phenomenon. Now, because there are a lot of flows, that doesn't happen. Right? FIs can invest in directly or through mutual funds. They can buy units through directly from the issuer or in the through a registered stockbroker on a stock exchange. These investments are subject to limits notified by SEBI. SEBI also monitors all FIs. And foreign institutional investors play a very important role in the economy. They play an important role through the investment mutual funds because of the following reasons. One, they improve the corporate governance. Because FI investors are there, they actually are very, very demanding of mutual funds and they ensure that the corporate governance is very, very high standards. They improve the competition market. With the investments of FIs in mutual funds, improvement takes place in the capital market because more investors come in, more people come in. So, if there is more investors, then there are more mutual funds also and there is good competition, healthy competition. Improved inflow of capital in the economy. The investment of funds in mutual funds in the economy, not only employment is generated, but position of foreign exchange also inflows. So, when FIs invest in a country, they bring their foreign currency. They bring that currency, give it to our local bank here. The local bank exchanges and gives them rupees. That rupees they invest in Indian market. So, when they take back money also ulta happens. They sell the stocks, get money in rupees, give it to our local bank, take dollars and go away. Right. So, they help improve our foreign exchange flows as well. However, again, FI flows are volatile. They may come in, they may go out, they may impact the stock market very, very negatively if there are hot flows, that is very short term flows where they invest fast, leave out fast and so on and so forth. So, this is the entire setup, this is the entire theory portion of mutual funds. Next, we will move now to the practical aspects. We will solve some questions, approximately 10 to 12 questions, which are highlighted, important questions that I have already highlighted in the class, in my videos earlier. And we will solve those questions and you will be completely thorough with all the key aspects of the mutual fund chapter. So, now let's go and look at these questions. So friends, so far we have looked at a lot of theory aspects related to the mutual funds chapter and I've also covered some basic bits of practical questions. But we actually, before we get into solving more questions, I want to show you something. This is basically the kind of questions or rather the weightage given to mutual funds chapter. So if you look at these questions, right, mutual funds chapter, you would see here that the weightage is actually significantly high. You have had questions of about 16 marks in one attempt, 8 marks, 12 marks, 8 marks, 14 marks, so on and so forth. This chapter is a very, very important chapter if you ask me. And they've asked tricky questions. They've asked genuinely tricky questions. Now, coming back to actually looking at some of the important questions, I've already given you the list of important questions. I'm going to solve those important questions only so that you can get a comprehensive understanding of this particular chapter. So, now let's go ahead and look at those important questions, solve those important questions. First one is question number 3, illustration 3 from my compiler, which all of you have already access to. If you don't have, click on the link given in the description of this video, you will get access to it. It's a file that you can download. Mr. X, an investor, had purchased 200 units of ABC mutual fund at a rate of 8.5 per unit 1 year ago. Over the year, Mr. X received 0.9 as dividend and has also received capital gain distribution of 0.75. We are required to find out Mr. X holding period return assuming the no load fund has an NAV of 9.10 as on today, and Mr. X holding period return assuming all the dividends and capital gain distributions are reinvested into additional units at an average price of 8.75. So you have two elements in this question. First one is, see in this particular problem and a lot of other problems in chapters that especially like M&A or corporate valuation or even portfolio management to that extent, even derivatives and forex, it is very important to write down information given in a proper, easy to understand format. More so for mutual funds chapter. Format solves half your problems. Okay, if you put them in a tabular form, trying to progress line by line, I am pretty sure that you will actually understand the question and solve the question much faster. So they have given what he has purchased 200 units of at an NAV of 8.5. Okay, closing NAV is also given as 9.1. So you write that 9.1. Dividend that has been paid is 0.9 and capital gain that has been paid is 0.75. So the total payment that has been made to them is 1.65. And they have said assuming all dividends and capital gain distributions are reinvested at 875. So reinvestment NAV is 875. So you have first listed out all the per unit items. Then first what have they asked? Mr. X holding period return assuming the no load fund has an NAV of 9.1. 9.1 is the closing NAV. And they said it is for 1 year, and they have also said that it is no load fund, and they have said what? They have said one more point. NAV as on today. So you have to find out what is the holding period return for over this 1 period. So holding period return is what formula is closing NAV minus opening, basically the increase in NAV, plus any capital gains plus any dividend that is received. So that is the numerator. Denominator is your opening NAV. It is very simply the increase in net assets value and increase in cash that you have got. Right. So you basically get increase in net asset value is 9.1 minus 8.5, which is 60 paisa, and then you have 1 rupee 65 paisa, which is capital gain plus dividend. 165 plus 60 is 225. So 225 is the numerator, and opening NAV, opening investment was made at 8.5. So 2.25 by 8.5, you get a percentage of 26.47. It's a fairly simple thing. You just have to write stuff in a format, in a easy to understand format. Then second question is what? The holding period return assuming all the dividends and capital gain distributions are reinvested into additional units at average price of 8.75. Now, if you are reinvesting at 8.75, what happens? Originally, dividend and capital gains is 1.65. That is what is the dividend per unit that you have got. How many units do you have? You have roughly about 200 units. So 200 into 1.65. Not roughly, actually you have 200 units. So 200 into 1.65 is 330 rupees. This 330 rupees you reinvested back at what rate? 8.75. So how many units did you get? If you recollect the dividend reinvestment option that I explained towards the end of the theory discussion, you would realize that I explained that the dividend that is received, or rather the money that is received from the mutual fund is reinvested back into the mutual fund by buying new units of the same scheme. So you use this 330 rupees you use this 330 rupees to buy some units, and cost of each unit is 8.75. So 330 divided by 8.75. Where did I get that 8.75? They themselves said, assuming the distributions are reinvested average rate of 8.75. So you get 37.71. So 37.71 is the number of units that you got. How much was the original units? 200. So total units is 237.71. So your total unit is 237.71. But what is the value of the investment? The value of the investment at the end of the period is 9.1 per unit. So you multiply 237.71 into 9.1. You get 2163.16. 2163.16. And then from that, there is the closing NAV. Do you add capital gains and dividend here? No, you don't. Why? Because that particular amount, instead of coming in cash, you've already received it in the form of additional units. So total closing value is 2163. And what was the initial investment value? You invested 200 units at 8.5, which is 8.5 into 200 is 1700. So 2163.16 minus 1700 divided by 1700, you basically get this 463.2 by 1700, which is 27.25. Now, in an ideal scenario, both of them will be same, provided you get the dividend on, let's say, the last day or something like that. Only then they both will be same. If you got dividend somewhere in the middle and the reinvestment rate is something else, then obviously these both holding period returns will be very, very different. Because one is purely based, one accounts for cash received, another accounts for units received. Both of them have to happen on the same day. If they happen, let's say, towards the end, then you should take the ending NAV. right? So, but here we have not taken ending NAV, we took 8.5 and 9.1, somewhere in between we took. So, it probably would have happened somewhere in the year, between the year. So, they both will not be the same. Now, let us move to a question on front end load or entry load and exit load. The unit price of ELSS scheme of a mutual fund is rupees 10. The public offer price or POP of units is rupees 10.204 and the redemption price is 9.8. Okay. Now, what is the face value? Face value, because they themselves said the unit price is 10 rupees, you invested at 10. The face value per unit is 10, and what did they say? The public offer price is 10.204. So, the offer price is 10.204 and the redemption price is 9.8. So, you invest at 10.204, you redeem at 9.8. Now, what is entry load? Entry load is the extra amount that is charged by the mutual fund company when you make an investment. Even though face value is 10 rupees, you are asked to give 10.204. So, you are paying 2.204 extra. So, what is entry load? 0.204. Here it is 10.204 minus 10 by 10. Yeah. So, what is the entry load? Extra 0.204 on 10, which is 2.04%. Same way, exit load. What is exit load? When you are selling off the units, instead of getting 10 rupees, you are going to get 9.8. Right. So, exit load is 10 minus 9.8 by 10, where basically exit load is 2%. So, it is a fairly simple computation, there is nothing else. But here, I am doing this problem just to ensure that you understood what is the concept of entry load and exit load. Next, during the year 2017, an investor invested in a mutual fund. The capital gain in dividend for the year was rupees 3 per unit, which were reinvested at the year-end NAV of 23.75. Okay, so I will actually stop highlighting because it is hiding data. Right. The investor had a total units of 26,750 at the end of the year. The NAV had appreciated by 18.75% during the year, and there was an entry load of 0.05 at the time of when the investment was made. The investor lost his records and wants to find out the amount of investment made in the entry load in the mutual fund. So, you get a lot of questions in mutual fund chapter which are of this type, where they give you half information and expect you to find out some other information. So, what is opening NAV? They have not told opening NAV, we will compute it, but they have given closing NAV. What? Closing, they had 26,000 units, right? If I'm 26,750 units. So, if you look at the closing or rather the units, the investor had total units of 26,750 at the end of the year. So, that is one piece of information which is very important, which we can write down here. Then, they said the capital gain dividend for the year was 3, which was reinvested year-end NAV of 23.75. So, closing NAV is 23.75, capital gain in dividend is 3 rupees. Okay, then the NAV had appreciated by 18.75% during the year. So, original value plus 18.75 is equal to 23.75. So, you can actually work backwards and use this to arrive at opening NAV of 20. How will you do? 23.75 divided by 1.1875. Why am I doing 1.1875? 1 plus 18.75%. Right? You will basically get a number of 20. So, opening NAV is 20. Then, if you have opening NAV of 20, we don't know how many units are there. But, what is the point? It is clearly said there was an entry load of 0.05 at the time of investment. We will think of it separately. Then, what did they say? They said, they were reinvested at year-end NAV of 23.75. So, some units was received. So, how much was the unit? Per unit, 3 rupees was received. So, let us assume that the opening unit is X, then reinvested capital gain in dividend is X into 3, because per unit 3 into X is the total capital gain in investment, capital gain in dividend that is reinvested. So, 3X is what you have reinvested. 3 basically is per unit, X is number of units, and you have reinvested it at 23.75. So, you basically draw an equation which is basically opening units of X plus 3x, which is the reinvestment made, divided by 23.75, because that is where you reinvested it at, you will get 26,750. So, which is what is this particular equation. You solve for this equation, you get a value. What is the value? You get value of x as 23,750. You get value of x as 23,750. So, from opening value is 23,750, you had opening NAV of 20. So, your investment was 23,750 into 20, which is 4,75,000, and you also paid an entry load. Entry load of how much? 0.05. There was an entry load of 0.05 at that time, when the investor lost his records and wants to find out amount of investment made and the entry load in the mutual fund. So, they want you to give you absolute value of entry load, because they themselves already have given you 0.05 as the entry load. So, There is no point quoting that 0.05 number back to the in the solution. So you have to give actual amount of entry load that was paid. 23,750 into 0.05 will give you 1187.50. But the NAV that you will get is 20. But the investment that is made, or rather the value of the investment that you made is 20 into 23,750, which is 4,75,000. But the actual outflow is including the entry load, which is 1187.5. So the total investment made is 4,76,187.50. Okay, this is your investment, but the NAV at which you are allotted is only 20 rupees. Right, which is what we allotted. So that is this particular problem. Let us look at the next one. So you get a lot of questions which are like this, where you have to find a missing number. Let's move to the next one. Mr. A can earn a return of 16% by investing in equity shares on his own account. He is now considering a recently announced equity-based mutual fund scheme in which initial expenses are 5.5% and annual recurring expenses are 1.5%. How much return should the mutual fund earn to provide Mr. A a return of 16%? See, on his own he can earn 16. Now, mutual fund has to earn some 20 or 21 or something like that, so that when you subtract every year 1.5% and initial investment value itself you subtract 5.5, on net basis finally he gets 16 from mutual fund, which is same as what he is getting on his own, because that's the opportunity cost. So, how do you compute? Required return is 16. Initial expenses 5.5. So, when you invest 100, 94.5 is actually what invested. The 5.5 is going away as initial expenses itself. So, and annual recurring expense is 1.5. So, every year you incur 1.5 and initial investment is only 94.5. So, what you should do is, initial value is 1 minus 5.5%, which is the initial investment value, and every year you should generate 1.5 plus 16, which is 17. So, you do 17.5 divided by 0.945. You basically will get 18.43%. This 18.43% is what mutual fund should earn. Then you subtract that 1.5%, you basically arrive at 16.913. So, the 16.9312% is the return that you get on 9.45. So, what is the actual return? 16.9312 divided by 100 into 9.45. So, you actually get a value which is 1.59999, which is 1.6. You basically get 1.6 as the return for 10 rupees that you invested, which basically works to 16%. Interesting question, it's slightly twisted question as well. Let us move to the next one. Mr. P has invested in 3 mutual fund schemes. What are these schemes? X, Y and Z. Date of investment is 1/11/2016, 1st Feb 17 and 1st March 17. Amount invested is 1 lakh, 2 lakh, 2 lakhs. NAV at entry date is 10.3, 10, 10.1. Dividend received up to 31st March 2017 is 2850, 4500 and nil. NAV on closing date is 10.25, 10.15 and 10. Assume a year as 365 days. Show the amount of rupees up to 2 decimals. You are required to find out the effective yield up to 3 decimal points on per annum basis in respect of each of these 3 schemes. So, you are supposed to find out effective yield, that is basically what is the yield that has been generated on the investment that you have made. This is not an annualized, they have said annual on per annum basis, yes. So, you have to give an annual effective yield. So, how you do is, originally you invested 1 lakh, 2 lakh and 2 lakh, that is the original value. And when did you invest? 1st November, 1st February and 1st March of 2017. So, 1st November to 31st March you have 30 plus 30 in November plus 31 in December plus 31 in Jan plus 28 in Feb plus 31 in March. So, you basically have 151 days. Same way you compute for the second one. You invested on 1st Feb. It is 28 plus 31, which is 59 days, and third one is 1st March, so it is 31 days. So, invest in each one of them for 151, 59 and 31 days respectively. That is what you are supposed to do when you have the opening date and closing date. Then, the invested NAV, they have clearly given us 10.3, 10 and 10.1. So, you write that down. Then, most of this problem, or most of the problems in mutual fund chapter, as I am repeating again and again, is about writing down the data and, simply following a format. Closing NAV is 10.25, 10.15 and 10. So, invested units is how much? When you invested 1 lakh at 10.3, what is the number of units? 1 lakh divided by 10.3 is 9708.73 or 737. So, 74. So, they said show the amounts of rupees to 2 decimals and yield up to 3 decimals. So, okay, 9708.74. Same way, 2 lakhs divided by 10 is 20,000, 2 lakhs divided by 10.1 is 19,800. So, that is the invested units. Now, what is the closing investment value? Closing investment value is you multiply the number of units that you find out here and the closing NAV that is here. You multiply those two, you will basically get the closing investment value, which is 99,000, 203,000, 1,98,000. Then, what if they asked after that? They have also received dividend. How much is the dividend? Dividend received is 2850, 4,500 and 0. So, what is the total return that has been achieved? Total return that has been achieved for scheme X is 2850, which is what you've got as dividend and capital gain, and there is a reduction in NAV from 1 lakh to 99,500. So, there is a 484 rupees reduction. So, you adjust for those two, you get 2364 as the actual absolute value of return that you have made. Same way, you compute the return for other one also. Increase in NAV is 3,000, dividend is 4,500, total increase is 7,500. So, and you compute the absolute return. What is absolute return? Absolute return is the total return or the holding period return. Absolute return or holding period return. What is the holding period return? 2,364. What we have here. 2,364.56 divided by 1 lakh, which is 2.365. 2.365% is a holding period return, but you have held it only for 151 days. So, what do? Multiply by 365, divide by 151. So, 2.365 into 365 divided by 151. You get 5.716%. Okay, like that you do for the other two also, you will be able to solve the problem. This is known as effective annual yield, whereas this absolute return or holding period return is basically the return that you have generated by holding it. So, you invested this much, you got back this much. You are not considering time element. Once you consider time element, you adjust it for the time. That is, you multiply by 365 divided by the actual number of days for which you have held the investment. So, this is another variety of problem. You will get slight variations in this also. In this, a lot of students get actually confused about the dates. So, my suggestion always is, when they say that they made an investment on that day, consider the day. When they are asking you to compute the last day, consider that day also. Okay, so take both of them into account. Okay. However, when they say somebody has redeemed on last day, then that day you will get the money on the next day. So, even there you will actually consider the NAV of the last day. So, even for count purpose, you will get the same value. Okay. Then, moving to the next question. A mutual fund has two schemes, that is dividend plan A and bonus plan B. The face value of the units is rupees 10. Face value is rupees 10. Mutual fund has two schemes, dividend plan and bonus plan. The face value of the unit is 10. On 1/4/16, Mr. Anand invested 5 lakhs in each plan, and the NAV was 46 and 43 and a half. So, this was 46 and 43 and a half. Both the plans matured on 31st March 19. Particulars of dividend declared over the period as follows. You are required to calculate the effective yield per annum in respect to the above plans. Okay, so now you invested 5 lakhs, and what is the NAV on that date? NAV on that is 46 and 43.5. So, you divide 5 lakhs divided by 46, you will get 10869.56, which is what you got here. Then 5 lakhs divided by 43.5, you will get 11494. 5 lakhs divided by what is the thing for second plan? Second plan is at 43.5, you get 11494. Then that is the first initial units. Now, for this units, what has happened? This is invested on 1/4/2016, whereas the dividend, or rather the bonus, whatever is there, was declared subsequent to that. So, on 36, let us first look at the plan A, which is basically the dividend plan, right? So, at 30th of June, at NAV, when NAV was 46.8, dividend of 15% was declared. So, one more thing that you have to understand is, all these amounts are reinvested. You are required to calculate the effective yield per annum in respect to the two plans. All these yields are reinvested in the same plan. That's a very, very important assumption. Why do you have to make an assumption that all the money that is coming is reinvested? See, in case of bonus plan, it is direct bonus issue, so there is no problem. Whereas in case of dividend plan, why do you need to assume it is reinvested? For simple reason, because if you don't consider reinvestment, what is happening to that money? You will compute a holding period return and absolute return. What will you do with that return? That money is lying somewhere unutilized, no? So, then you will have to put it in FD or somewhere, or again buy back these units, which is exactly what we are assuming. We're assuming that all these units are reinvested, and we are also assuming that in case of a dividend reinvestment plan, there is no tax impact, there is no capital gains impact also. In some questions where they give you capital gains impact or tax impact, you have to consider it. In this question, we will assume both the things. All the units of the dividend, all the dividends received are reinvested in the same plan, and there is no tax impact on dividend reinvestment. Now, when this dividend is declared, how is the dividend declared? The dividend is always declared on the face value. What is the face value? Face value per unit is 10. Okay, 10 on 10, 15%, which is 1 rupee 50 paisa. So, 1.5 into, for how many units are there? You have invested in 10,869.57. So, 1.5 into 10,869.57. That you will get 16,304.35. So, you have got a dividend of 16,304.35. Now, a lot of students I know would have computed, 5 lakhs into 15% is some number 75,000. That is not the right way. You invested 5 lakhs, but the investment, whatever investment you made, not everything went into face value of the unit, no. Only some amount, 10 rupees went into face value, balance amount went into the NAV building, which was already, because the scheme was already existing. So, whereas you are paid dividend only on the face value portion. So, this is how you have to compute 15% on 10 rupees, which is 1 rupee 50 paisa for the number of units. So, per each unit you get 1.5 and you get 10,000 units, total dividend is 16,304. Now, also please note, in this particular chapter, you can have units in partial fractions or decimals also. You can go up to 2 or 3 decimals. If they specifically say use 3 or 4 decimals, that is fine. Otherwise, 2 decimals is usually okay. So, 16,304 is what is the dividend that you got. Now, that dividend is reinvested. Reinvested at what rate? 46.80. They themselves have said. So, divide by 46.80, you get basically investment of 348.383. So, you've got additional units of 348.38. Like that, every year you declare the dividend comes to you, the dividend is reinvested in some units, that units add up to your opening units. So, like that you can keep doing, and what happens at the end of the period, both the plans matured on 31/3/2019. So, 31/3/2019, what is the NAV? They themselves have said 52.4 and 50. So, you take 52.4 here, multiply with the number of units that you have, which is 12,400, you get 6,50,000. Now, the 6,50,000 is ending value. What is the investment value? 5 lakhs. What is the holding period return or absolute what is the holding period or absolute return? You do 6,50,000 minus 5 lakhs. Now, why no capital gains and dividends? Because all of those are reinvested already. So, everything is captured in the number of units. So, number of units into closing NAV divided by number of units that was opening into opening NAV, which is basically 5 lakhs. So, you get a return of 1,50,000 over 5 lakhs, which is approximately 30.05%. But 30.05 is over what period? You made an investment on 1/4/2016. 1/4/2016. So, 16 to 17, 17 to 18, 18 to 19 for 3 years. Now, you made a return of 30.05 for 3 years, 30.05 for 3 years. Now, this 30.05 is the ending value. There are two ways to compute the annual return, annual yield, effective annual yield. You can compute it, one in IRR method, other way is you can compute it by simple return. So, here what you have done, 30.05 divided by 3 will give you 10.02. This is simple way. However, if you compound it, which is basically you are trying to find out the cube root. Why cube root? Because it is for 3 years. So, 1.5 lakhs divided by, or rather 6.5 lakhs divided by 5 lakhs whole power 1 by 3 minus 1. Now, for this you need to remember the calculator trick that we have there. So, which is why I typically don't expect CA Institute to ask questions where they ask you for cube root, 4th root, 5th root and all. Up to square root you can do straightforward on calculator. Otherwise, you have to use either log tables or you have to use that calculator trick what I taught you. So, which is why I would presume that doing a simple yield, simple interest yield or simple interest return is more common way for solutions that are asked in the CA exams. If you try and compute it using IRR method or 1 by 3 and all of that, you will end up at a rate which is close to 9.15%. Now, coming to the bonus plan. Now, bonus plan is very, very simple. It is far easier. Why is that the case? You have investment of 5 lakhs at 43.5, which is the opening NAV. You made this many units. On 31st August, you get a bonus of 1:6 at a NAV of 45. So, whatever number of units you have, 11,494, you are going to get for every 6 unit 1 unit. So, divide by 6 is the actual units that you are actually going to get. 1900 is the bonus you are getting. So, your total units is 1900 plus 11,400, which is basically 13,400. So, like that every bonus issue you keep adding the number of units. Finally, and please note, in all these times, the closing NAVs of bonus plan is irrelevant. Why? Because you are getting bonus based on existing count of units that you have and not based on any NAV related activity. So, what happens? Only the last NAV is relevant. What do you do? Closing units, 16,000 into 50 is basically what you will get as a closing NAV. So, 8,29,000 is the closing value of investment, opening value is 5 lakhs. You compute the return, you get 65.95% is the absolute or holding return, and you divide by 3, you get 21.98. In the same way like what we did for the previous portion. However, if you take inflow, outflow and all of that, you probably will get a slightly lower return at 18.4%, but that is a different matter because you have to do this whole cube root, investment, inflow, outflow and all of that. I don't think that is the right way to do it, because specifically you don't have to, I don't think that is the right way to do in exam. I actually think that it is the right way to do in real life. Okay, so please don't get me wrong. In real life, you are supposed to compute IRR. IRR is what determines. In exam case, because they don't allow you a cube root calculator or a scientific calculator and don't give you log tables or anything, you cannot compute cube roots or fourth root, fifth root and all. Even though you can use a calculator trick that I taught you, keeping that aside, you are expected to only compute simple return, which is 21.98% in this case. Okay. So friends, now let us look at the next question. This is Sun Moon Mutual Fund. It's an approved mutual fund, sponsored open-ended equity programs, Chanakya Opportunity Fund. There were 3 plans. In this fund, there are 3 plans. Okay, I don't know why they gave so much of language. Dividend reinvestment plan, bonus plan and growth plan. You know the difference between dividend reinvestment and growth, right? Growth, unit count doesn't increase. In dividend reinvestment, unit count increases. At the time of IPO on 1/4/2009, Mr. Anand, Bachchan and Charu, 3 investors invested 1 lakh each, chose B, C and A plans. So, ABC invested in B, C, again confusion. Anyway, the history of the fund. Dividend is so much and bonus is so much, and again they have given the NAV per unit, face value 10 for each of the 3 plans. Now, on 31st July 2019, all 3 investors redeemed all balance units. Calculate annual rate of return of Charu, who invested in A, which is dividend investment plan, annual return of Mr. Anand, who invested in B, bonus plan, and annual return of Bachchan, who invested in C, growth plan. Long-term capital gains is exempt from tax, short-term capital gain is 10% income tax, security transaction tax is 0.2, and ignore education sector. As I told you, right, some cases they may give you income tax details, but only if they give, you have to consider it. Otherwise, ignore all of them. Give it clearly in your assumptions. Now, what did Charu invest in? Charu invested in dividend reinvestment plan. Dividend reinvestment plan means the count of units increases. So, what happens? You invested initially 1 lakh. Each of them invested 1 lakh, right? On 1/4/2009. So, you had 10,000 units. Then, the dividend was given how much? 20, 70, 40, 25 like that. So, every time this much was the dividend that was given. Now, this dividend, whatever you have is, how did you arrive at the dividend value? Based on face value multiplied by number of units. So, face value is what? Face value is you invested at IPO only, right? At the time of IPO, they 3 invested so much. So, now you see at the IPO time, they will, or IPO or initial fund offering, whatever they call it, initial time you invested 10 rupees. So, on 10 rupees, you get how much dividend? 20%, which is on 10 rupees, you get 20% dividend, which is 2 rupees. But you have invested how many units? 10, you have invested 1 lakh for 10 rupees NAV. So, you have invested 10,000 units. So, 10,000 into 2 rupees is 20,000. This 20,000 is reinvested at an NAV of 30.7. So, you divide this 20,000 by 30.7, you get a number of units which basically is this, which is this 651. So, your total unit count closing is 10,000 plus 651, which is 10,651. Like that, 70% dividend, which is 70% of dividend is 7 rupees on 10 rupees multiplied by your closing units, which is 10,651. So, 7 into 10,651.47, you get 74,560.26. Okay, that is reinvested at what rate? At 58.42, divided by 58.42. You will get 1276.28. So, these are the units that you get. So, like that you make a chain and finally compute the total number of units that you have, which is 14,906. Now, this 14,906 is what? Is redeemed. Charu invested in plan A, right? So, it is redeemed on which date? 31st July. So, 31st July, you redeem it. What is the NAV on 31st July? 53.75. So, you multiply 53.75 into 14,900, you get a value of 8 lakh. On this 8 lakhs, they have said what? There is a short-term security transaction tax on sale or redemption. So, on entire 8 lakhs, you have 0.2%, and then you have short-term capital gains. What is short-term capital gains with respect to securities? Less than 1 year, right? Less than 1 year. Now, what is the units that you have invested for less than 1 year? You have invested units which are up to last 1 year, 31st July 19, meaning anything that is after 31st July 2018. So, you have only one value, which is this units of 1400 and or the rupees 55,000 is what you basically reinvested. So, that 55,000 was invested at an NAV of 48.1 and redeemed at an NAV of 53.75. So, you basically compute 53.75 minus 48.1, that is the number of that is the increase in NAV for how many units? That is increase only for these 1144.43 units. So, on that you compute 10%, you get 646 rupees. So, you will get net amount after subtracting those two, you will get 7,98,000. Originally invested 1 lakh. So, total return is 6,98,000, and so return absolute is 699%. It is not 6.99, actually is 699%. Now, 699% is from when? From 2009. And when did we redeem? 2019. So, It is invested in 9 and you got it back in 19. So, it is 10.25 years. So, this return of 699% you got it over 10.25 years. You divide that, you will get roughly about 67-68%. So, that is what is the basic answer. Now, you can, instead of dividing it by 10.25 years, you can make 10.26 or something, because you have more number of days. If you count it based on days, you will obviously get a slightly varied answer, but broadly that is the way you solve this question. Now, second case is bonus. Bonus is also very simple activity. In case of bonus, your allotted bonus continuously at different NAV. So, your allotted bonus. So, every time unit count keeps increasing, and that unit count, whatever is increased, will get added to the total unit. So, originally you made 1 lakh at 10,000 units, which is face value of 10 rupees. Then you got a bonus of 5:4. So, when you get bonus of 5:4, NAV is irrelevant. So, for every 4 you get 5. So, you originally invested 10,000 units at 10 rupees each. So, for those 10,000 units you got 10,000 by 4 into 5, which was 12,500. So, your total count, unit count increases to 22,500. Like that, you do all of this, you get unit count of 37,500. That 37,500 at closing NAV of 22.9 is 8,61,000. So, 8,61,000 is your total value that at which you have basically sold, or at which you have redeemed all the units. Now, what is the net realization or net consideration? Net realization is, here you are trying to find out the short term capital gain. Now, what is the short term capital gain? Short term capital gain is the bonus that you have got. When did you get the bonus? Last bonus you got was on March 2019. March 2019, how many units did you get as bonus? You got 7,500 units. These 7,500 units were allotted to you at what NAV? At an NAV of 19.95. So, 7,500 into 19.95. So, on what is short term capital gains computed? Only on something that happened in the last 1 year. So, 7,500 units are what we are bothered about. 7,500 into 22.98, that is the rate at which you sold. So, it is 1,72,350, but what is the cost of acquisition? It is a bonus. So, 0 is the cost of acquisition. So, on one entire 1,72,000, you get 10%, which is 17,000, and then on original 8,61,500, you get 0.2% as STT, which is 1,700. So, the net amount realized is 8,60,000 minus 17,000, you get the final amount realized as 8,42,000. What is the original investment made? 1 lakh. Total investment value, or rather total increase in investment is 7,42,000, which is return of 743% over 10.25 years. You divide 743 divided by 10.25, you will get something around 71-72%. Right. So, this is what you do in case of plan B. Now, coming to plan C. What is this? This is growth plan. What is the investment made? Investment made is 1 lakh, and what is the closing value? Because there is no concept of dividend, everything, whatever is earned is invested back. Your closing value is 82.07. So, you multiply redemption value of 82.07 into the original number of units. In a growth plan, the unit count does not change. So, you multiply 82.07 into original 10,000. You get 8,20,000, and in 8,20,000, the STT is 0.2%, which is some 1,600. So, you basically get 8,19,000. On this, is there any short term capital gain? Because in this particular scenario, theoretically, okay, you've been given, you don't have any dividend or bonus or any of these numbers that are declared that are available to you. All the incomes are reinvested. When you don't have that information, what do you do? Even though you have NAV values, but you don't have the NAV value exactly 1 year before the redemption date. Even if you have the NAV value exactly 1 year before the redemption date, in case any growth happened in that period, the taxation impact is very different. The way you have to look at taxation, what you study in taxation versus what you are doing here is slightly different, because in this, you are not trying to prove to the examiner that you know taxation. You are trying to prove here to the examiner you know AFM very well. So, when they have not given information on tax liability or how to compute taxation, you ignore that. So, you can choose to, if you know how to compute tax on that, you have to want to make multiple assumptions and all, that's up to you. Okay, but I would strongly suggest don't do that, and rather compute simply. Take simply the holding period or absolute return and divide by the number of or actual period to get the actual annualized yield or annualized return. Okay, so that is this particular question, fairly lengthy question, fairly tricky also, where you will tend to make mistakes. So, you should be very careful. Now, let us move to the next question. On 1/4/12, ABC Mutual Fund issued 20 lakh units at rupees 10 each. Relevant initial expenses were rupees 12 lakhs. It invested funds so raised in capital market instruments to build a portfolio of 185 lakhs. During the month of April, it disposed of some of the instruments costing 60 lakhs for 63 and used the proceeds in purchasing securities of 56 lakhs. Fund management expenses for the month of April were this 8 lakhs, of which 10% was in arrears in April. In April 2012, the fund earned dividends amounting to 2 lakhs and it distributed 80% of the realized earnings. On 30th April, the market value of the portfolio was now 198 lakhs. Mr. Akash and investors subscribed to 100 units of 1/4/2012 and disposed of the same at closing NAV on 30/4/2012. What is this annual rate of earning? So, for you to compute annual rate of earning, you have to figure out what is the closing NAV, opening NAV versus closing NAV. What is the increase is basically what monthly return. That monthly return you compound it or you multiply it by 12, you get annual return. Now, what is the initial investment? 100 into 10 is 1000. That is what he did. So, what is the income and dividend received? We will come to that. Okay. For all of that, we will first have to work out what is the funds cash balance or what is the funds NAV. Without computing funds NAV, nothing can be done. So, what is an NFO? Initially, how many units were issued? 20 lakh units at 10 rupees. So, 20 lakhs into 10 is 200 lakhs. For that, you actually get a cash of 200. Then you have initial expense of 12 lakhs. You subtract 12 lakhs, you get 188. Then you make first investment at 60. Okay. So, cash comes down to 128. Then second investment you made, first investment you made was 60. Now, what did they say? It invested the funds so raised in capital market instruments to build a portfolio of 185 lakh. So, out of 185, 60 is invested first. So, balance is 125. So, you have to read the question very, very carefully. So, you invested next 125. So, the closing cash balance is 3. Then, you sold the first investment for 63. So, you got total cash is 66. And then you made again a fresh investment of 56. So, your cash is now 10. Then, you have fund expenses. What are the fund expenses? This 56 is over. This is over. Fund management expenses for the month of April was 8 lakhs, of which 10% was in arrears. So, you did not incur entire 8 lakhs. 8 lakhs is the amount that is accrued, but the actual cash outflow is only 7.2, which is 90% of that 8 lakhs. So, the cash balance is 2.8. Then, what else? What else was the other information? The fund earned dividends amounting to 2 lakhs and it distributed 80% of the earnings. So, this 2 lakhs is what is earned. So, cash balance is 4.8 and distributed 80% of 2, which is 1.6. So, the cash balance comes down to 3.2. Then, of the realized earnings on 34, the market value of portfolio was 198. Okay. Then, it also distributed capital gains. What is this capital gains? Where did this capital gain comes from? Arey boss, you originally had bought something at 60 and sold at 63, no? So, on 3 also there is 3 of capital gains. Of that 80%, which is 2.4. So, you distributed 2.4 also. So, cash balance is now 0.8. So, closing cash balance is 0.8. Why is this cash balance relevant for us? In order to find out the NAV. Closing value of securities is 198. Whatever the securities that you have purchased, originally for 125 and then for 56, which adds to 191, now 198. And you have cash of 0.8 and you have fund expenses arrears of 0.8. So, you subtract that. So, total NAV is 198. And 188 lakhs is total NAV for how many units? For 20 lakh units. So, NAV of each unit is 9.9. Now, when you come to this particular investor, originally he invested 100 units at 10 rupees at 1000. Then he got capital gains and dividend of 20 rupees. How did he get 20 rupees? See, we have distributed how much dividends? We have distributed total dividend of 1.6 plus 2.4. We have distributed dividend of 4 lakhs. Now, 4 lakhs is distributed for how many units? By 20 lakh units. Right. So, each investor got 0.2 rupees. Now, he had how many units? In 100 units. 0.2 into 100 is 20. So, that is how he got a dividend and capital gain of 20. Now, what is the redemption value? You sold it off at the end of the month at 9.9. So, 100 into 9.9 is 990. So, absolute return, that is the return that you made. Closing minus opening, 990 minus 1000 plus 20. So, you will get a return of 10 rupees. 10 rupees on investment of 1000 rupees. So, you get 1%. 1% is for 1 month, 12% is for 12 months. You see, so in this kind of questions, unless you realize that the working capital and NAV have to be computed, unless you realize the importance of the computing this NAV and cash balance, everything else is going to be a tough task. You cannot randomly walk into the exam, you cannot randomly start off the question and figure out, you'll start solving and somehow magically you'll get the answer. You should know that cash balance and NAV have to be necessarily computed. And in this, there is also this tricky part of payment of capital gain also. Right, payment of distribution of capital gain that is earned also. That's a tricky part. Let us move to the next question. Let us look at this question. A mutual fund made an issue of 10 lakh units of 10 each on 1st January 2008. No entry load was charged. Very good. It made the following investments. It invested in 50,000 equity shares of 100 each at rupees 160, which is 80 lakhs. 7% government securities 8 lakhs. 9% debentures unlisted 5 lakhs. 10% listed debentures 5 lakhs. Total investment 98 lakhs. So 10 lakh units into 10 is 1 crore. Out of that, it invested 98 lakhs. 2 lakhs is its cash balance. During the year, dividends of 12 lakhs were received on equity shares and interest on all types of debt securities was received as and when due. At the end of the year, equity shares and 10% debentures are quoted at 175% and 90% of their value respectively. Other investments are at par. Okay, now find out the NAV per unit given the operating expenses paid during the year amounted to 50,000. Also find out the NAV of the mutual fund and distributed dividend of 0.8 during the year. It's a very simple. So this is a NAV kind of a question. If you get this kind of questions in exam, full toss. Okay, out of the cricket stadium or out of the park. Okay, what is the NAV here? So here only thing that you may have a doubt is are quoted at 175%. Now 175% of the investment value, 175% of the face value. I would typically say that it is face value only. Okay, whenever somebody says 15%, 15% dividend, 100% of the value and all that, take it as face value unless they say of the investment value or unless the sentence structure reads or it enables you to make an assumption that is investment value. Now, equity shares, you have 50,000 equity shares, that is what they only said, at 175, which is 87.5 lakhs. Then you have government securities which are quoted at 90%, that's what they said, and 10% debentures are quoted, okay. Government securities are 8 lakhs, debentures are 5 lakhs and this 5 lakhs of unlisted debentures are quoted at 4,50,000. So, total value of investment at the year end is 1 crore 5 lakh. Now, this is the assets. You also have to add any incomes, subtract expenses, subtract fees, subtract arrears, add arrears income and all of that. So, dividend, how much dividend was received? They themselves have said dividend of 12 lakhs was received and then they said distributed dividend of 0.8 per unit. So, 10 lakhs units into 0.8 is 8 lakhs. So, they distributed a dividend of 8 lakhs. We'll come to that there. Then, interest on government securities, whatever securities you had, you received the income. So, 7% into 8 lakhs is 56,000, 9% into 5 lakhs is 45,000 and 10% is 5 lakhs is 50,000. So, these are the three incomes that you've got in addition to the dividend from equity shares. Then, you also have operating expenses. What are the operating expenses? Operating expenses paid during the year is 5 lakhs. So, you add that 5 lakhs. So, net cash received from all these activities is 8,51,000. This 8,51,000 and cash originally that you raised and did not deploy. 1 crore you raised and you deployed only 98 lakhs, so 2 lakhs. So, your net cash that is increased is 10,51,000. From this 10,51,000, you also have paid a dividend of 0.8 rupees. 0.8 rupees. So, the revised NAV will be after adjusting this 0.8. 0.8 into 10 lakhs is 8 lakhs. So, minus 8 lakhs. So, you will basically have a value of 2,51,000 which is the increase. In addition to this 1 crore 5 lakhs. So, 1 crore 5 lakhs plus 2,51,000 is 1 crore 7,51,000 and you have how many units? By 10,000 units. So, you get an NAV of 10.751. This is what is the revised NAV. Or you can subtract dividend per unit or you can also subtract dividend on the gross level. Either way, you will get the same answer of 10.75. Okay, let us move to the next problem. So, friends, now let us look at this next question. This is an interesting question, one because, Institute has asked a similar question, I think twice in exams I think once in 2018-19 or 19-20 and once again in 21-22. But the issue is there is a small error in the question. Nevertheless, I will tell you what the error is, but you have to be, in the exam, this kind of question, first time when it came was actually very tricky. Okay, so you have to be fairly careful when you are solving a question like this. Let us read the question. The question is, MS Corpus and AMC on 1/4/2015 had floated two schemes, that is a dividend plan and a bonus plan. Mr. X, an investor, invested in both the schemes. The following details except the issue price are available. So, when you float a scheme, this is the first issue that I have with, problem that I have with the question. Whenever there is a issue, I have never seen in my life an NFO, new fund offer, coming at a price which is different than 10 rupees. If you start a scheme, the face value of the unit is equal to the money that you are putting in, which is 10 rupees. It is impossible that you put something at a different rate, you put something at 40 rupees or 50 rupees or 60 rupees and the face value is 10. This is not like a shares kind of a scenario where you have on the day zero itself, whenever you invest money, there is an assumed value. Mutual fund, till you actually invest money in a portfolio of shares or other assets, there is no intrinsic value as allotted to it. It is just the face value. What you give them is what the value is. But unfortunately, that is the first fundamental, most glaring mistake that is there in this question. That will manifest, or rather that will show up in other places when we move forward. Okay, so basically what they are saying is we don't know the issue price even though it was a NFO, a new fund offer. So on 1/4/2015, there was a dividend plan ka issue, a bonus plan ka issue. We don't know what is the price, issue price. Then what they are saying is on 31/12/16, there was a bonus of 1:4 when the bonus plan was at 40 bucks. Then subsequently 31st March 2017, there was a 12% dividend on dividend plan when NAV was 48. On 31st March 18, there was a dividend of 10% when the NAV was 50. On 31st December 2018, there was a 1:5 bonus issue when the NAV was 43. Different plan, obviously, bonus plan. And then 31st March 19, there was a 15% dividend when the NAV of the dividend plan was 45. And on 31st March 2020, the NAVs of both the plans are 49 and 44. Additional details are investment you made in dividend plan 9.2 lakhs and in the bonus plan you made 10 lakhs. You know the value of the investment, you don't know the price at which the investment was made, or you don't know the rate at which each unit was purchased, and you also don't know the number of units. Number of units also not known, you see, because they have just given the investment value, then they have given average profit for the dividend plan is 27,748.6 and for the bonus plan the average yield is 6.4%. Okay, you are required to calculate the issue price of both the schemes. So now you have closing NAV, you have initial investment. So initial investment, you are now supposed to compare the closing investment divided by the closing NAV to get the closing units. From closing units, you work backwards and arrive at opening units. That is the logic. That is the simple logic. Right. So if you look at the data, I am just first plotting the data. You have dividend plan closing value 9.2 lakhs, sorry, this is investment value 9.2 lakhs and 10 lakhs. The first one was dividend plan, right? Average profit over what period? You invested in 15 and the closing date is March 20, 1st April 15 to 31st March 20, 15 to 16, 17, 18, 19, 20, 5 years. So for 5 years, you got an average profit of 27,748.6. So you multiplied by 5, you get 1,38,743. This is the total profit. If this is the total profit, the opening value of investment made is 9,20,000 plus you add 1,38,743. You get closing value of 10,58,743. So this is the closing value of the investment. From this closing value, you already know the closing NAV of 49. So you divide it by 49 and arrive at closing unit count of 21,607. So you arrived at the closing unit count. Same way for the bonus plan, average yield is how much? 6.4%. What they said, 6.4% over 5 years. So per year it is 6.4 into 5. Per year is 6.4. So for 5 years it is 6.4 into 5, which works out to 32. 32% is the overall yield over how much period? 5 years. So initially you invested how much? Initial investment was 10 lakhs. So on 10 lakhs you got 32%, which is basically the closing value of the investment is 13.2 lakhs. 10 plus 3.2 is basically 13.2 lakhs. 13.2 lakhs, what is the NAV value? Closing NAV 44. So you divide the closing value of investment by 44, you get 30,000 as the closing number of units. Now that we have got closing units in both the scenarios, you have to work backwards and arrive at the opening units. Now, what is the opening unit count? So, first let us look at the bonus plan. You can take any plan. So, bonus plan closing is 13.2 lakhs at 44 rupees and 30,000 units. Then what did they say? There was a dividend of 1:5. So, for every 5 you get 1. So, totally you have now 6. Originally you had 5, now you have 6. So, originally you had 5, then you have 1:5, then you have now 6. So, this 6 is equal to 30k. So, what is this 5 before the bonus? 30,000 by 6 into 5, which is 25,000. That is how you got this 25,000. Then there was another bonus of 1:4. 1:4 here. So, 25,000 is 1:4, meaning you get total of 5, and this 5 is equal to 25,000. So, what is 4? 4 is 20,000. How? 25 by 5 into 4. So, that is how you get 20,000. So, the initial unit count is 20. And this 20, you made it what? What is the initial value of the investment? You made 10 lakh rupees. So, 20,000 you invested at 10 lakh. So, the bonus plan NAV is 50 rupees when you made the investment. Okay. Now, as I told you initially itself, how can a new fund offer have a NAV of 50 when the face value is 10? I don't know, but ICA in its infinite wisdom told us to follow that, we are following it. Okay, I have never seen it in my life. Next, coming to dividend plan. Now, dividend plan is slightly more interesting. You need to use mathematics and equations, and here also you will have a problem. What is the dividend? Closing units, what we found is 21,607, and 21,607 is after giving 15% dividend. Now, 15% dividend is there. 15% dividend is on what? Dividend is always on face value. Now, here what is the issue price? We don't know the issue price. Is issue price equal to face value? No. The face value is always 10. They should have ideally mentioned face value is 10. Even if they mention face value is 10, I don't know why the issue price is higher than 10, especially when this is the first issue. Okay. So, you have to make an assumption that the face value is 10 rupees. If face value is 10 rupees, then you see the logic. Before the last dividend, what is the last dividend? Last dividend is 15%. After 15%, it is 21,607. So, you have y, which is the units, plus y into 10. 10 is the face value into 15%, because you are trying to compute the total amount of dividend that is actually declared. That you divide by the NAV, you will get the number of units that are reinvested. So, you have to make another assumption. In this dividend plan, all the dividends are reinvested. So, that is another assumption. They have not given it. Ideally, they should have given it. So, y, which is the opening units. So, let us say y is one number plus 15% dividend. Whatever is this amount, divide by NAV, you will get new units. This new units will be y plus 15% dividend by NAV. Okay, that is the basic logic. So, y is the dividend. So, y is the opening units, y into 10, because number of units into 10 rupees into 15%, that is basically total dividend value, divided by the NAV when the dividend was issued. When was the dividend issued? When the dividend was issued, the NAV was 45. So, divide by 45 will basically give you the total number of units, that is opening units plus dividend units is equal to closing units of 21,607. Y plus y into 10 into 15%, here 10 is face value of 10 into 15%, is only the second portion. It is only the second portion, which is not the first portion. Basically, the dividend value is only divided by 45. So, you solve this particular equation, you get 45y plus 1.5y is equal to 21,607 into 45, and you solve for y, you get a y value of 2910. So, 2910 is the opening, and you see 20910 into 10 into 15%, you get 31365. This you divide by 45, you get basically 697. 697 plus 2910, you get 21,607. So, the closing unit 21,607 is arrived like this. So, same way you solve this backwards, you also have two more dividends, one of 10%, other one of 20%, 12%. 10% is when the NAV is 50 and 12% is when NAV is at 48. So, I will show you again how it works. So, 21,910 we got. So, before 21,910 the dividend was how much? Dividend was 10%. So, I will clean this up. Again, I will use one number, x plus x into 10 into 15% divided by 50 is equal to 2910, and you solve for this. What was the dividend? I think dividend was not 15, dividend was 10%. You will get 2500. See, you got the number 2500. 2500, again you work backwards with the 12% dividend, you arrive at 20,000 units. So, that way you have got the opening units as how much? 20,000 in first case and 20,000 in second case. In both the cases, you got opening units that you made investment is 20,000 each. Okay. This is one particular problem I want you all of you to solve independently on your own in examination conditions, so that you proceed faster in the exam and don't wait scratching your head and thinking what is supposed to be done. Because this kind of question, if it comes in exam, first time when it came, it was a googly for everybody. Now, everybody did a simple full toss or a short pitch ball, anybody can hit it out of the park. Okay. So, please be careful, solve this kind of questions. They are very interesting, they are fun also. Okay. Now, let us move to the next question. So, now let us look at the next question. This is another interesting question, and this kind of question basically this accounts for your exit load, entry load, dividend reinvestment or dividend equalization, I am sorry, and all such kind of things you see here. As you read through the problem, you will understand. This is also a very interesting kind of question. This is slightly lengthy. And this is not necessarily, it's tricky also. I'm not saying it's not tricky, but it's also lengthy. On 1st April, an open-ended scheme of mutual fund had 300 lakh units outstanding with an NAV of 18.75. At the end of April, it issued 6 lakh units at an opening NAV plus 2% load. This is entry load. Adjusted for dividend equalization. What is the dividend equalization? We don't know. We'll see. At the end of May, 3 lakh units were repurchased at opening NAV less 2% exit load adjusted for dividend equalization. So, you repurchased. Okay. Then, at the end of June, 70% of his available income was distributed. In respect of April to June quarter, the following additional information is available. Portfolio value appreciation is 425.47, income of April is 22.95, income of May is 34.425 and income of June is 45.45. You are required to now calculate income available for distribution, issue price at the end of April, repurchase price at the end of May and NAV as on 30th of June. Now, this is a question which is extremely format driven. Most of the questions in this mutual fund chapter, as I told you multiple times earlier, are format driven. If you get the format right, you will be able to answer it quickly. Okay. So, now first, what is the units that you had originally? The 300 lakh units. And what is the original NAV? This original NAV was 18.75. Okay. You shouldn't forget that. Original NAV was 18.75. Now, what happened? For the month of April, it had 22.95 as income. Now, in end of April, it also issued 6 lakh units. Now, this income of 22.95, is it for the new units or is it for the old units? It is only for the old units. So, you take 22.95 lakhs, divide by 300 lakhs, you get 0.0765. 22.95 divided by 300, 0.0765. So, per unit, you are getting a 0.0765 income. Now, when the dividend equalization concept, if you remember when I was discussing, we will understand it much better when you solve a problem. So, this is what is that problem. Now, when new units of 6 lakh units are issued, the new units are not necessarily issued, the new unit holders don't necessarily get to share in the pie of this dividend of 0.0765 without paying for it, because they have not paid for it. The income was earned during April, whereas they invested on 30th of April or end of April. Right, so they are not entitled, but they are buying units. So what they will do is, along with the NAV, you will also correct the amount of dividend that is or income that is earned during that month. So what you do, 6 lakh units, you collect 0.0765 from those particular new unit holders. So you will collect 0.459 lakhs, and so your total units are 306 and 0.0765, which is the dividend, and the total value of income is 23.4090. Now, what happens in next part? And here please note, we are computing income available for distribution. There is a second part which is issue price and all of that. We will compute this in two different parts. Okay. What is income for May? You had 306 lakh units, and how much income did you earn in May? 34.425. Now, 34.425 divided by 306. 34.425 divided by 306 is 0.1125. So, 0.1125 is the income that you have. Now, when you have 0.1125 income, you have redeemed 3 lakh units. What did they say? End of April, 6 lakh units at opening NAV plus 2% load. Ignore the 2% load. We will come to the 2% load. At the end of May, 3 lakh units were repurchased opening NAV less 2% exit load. That also you ignore for a moment. Exit load. Just concentrate on this 3 lakh units. Okay, and adjusted for dividend equalization. Now, you see, these 3 lakh units you have repurchased. So, when you 6 lakh is fresh issue, meaning new people are coming in. 3 lakh means people are going out. When you are going out, you have to give them their dividend what is accrued till date. What is accrued till date? It is not just this 0.1125. Even the previous month dividend also has to be given off to them. So, you give them 0.1890. So, this 3 lakh people, you give them 0.180, you basically make a payment of 0.5670. So, your income available at May end is basically your 23 plus 34 minus 0.56, which basically, you see this, I will clean it up and I will add these numbers and show it to you. 23.4090 plus 34.4250 is equal to minus 0.5670. That will equal to 57.267. See, 57.267. That is the closing income available for the entire organization. Okay, then income for June. What is the June income? 45.45. So, you add 45.45 to that, which is basically about 15 paisa, because 45.45 divided by 303, you get 0.15. So, you totally have 303 units and total income is 102.7170 and the total income per unit is this 0.189 and plus 0.15, which is basically 0.3390. From this, what did you do? You distributed 70% of the income. What is 70% of 0.33? 0.2373 or 70% of 102 is 71.9019. So, basically, you have 303 units and the closing money after distributing, you have 0.1017 available and 30.8151 as the income available for this particular entire set of investment value. Now, what have they asked? They have asked us to find out two things: income available for distribution, which we have already found out. Then issue price at the end of April. Did we find out the issue price? We only found out the dividend equalization amount. Now let us come to the issue price. Opening, you had 300 and your NAV was 18.75. Total value was this. 18.75 into 300 is 5625. Then you add 2% entry load. Why? Anyone coming in now has to add an entry load. How much is 2% of 18.75? 0.3750. Then you also add, because new people are coming in, they are coming in at, they have to pay dividend equalization, which you already found out, 0.0765. You add that also. You get total issue price of 19.2015. So, investment, the NAV per unit at the end of April is 19.2015. What is the repurchase price? They have also asked that, no, issue price at the end of April, repurchase price at the end of May. 18.75 is the opening NAV. Then you have exit load of same 2%. So, when somebody is exiting, you don't pay them the money, you pay them less. So, you 0.37. Then you also pay them the dividend for the 2 periods, April and May, which we already computed here, which is 18.9. So, 0.1125 and 0.0765. So, you will basically repurchase it 18.564. Now, this is what you have repurchased. Now, you see here in both these cases, when you have issued at a slightly higher price than NAV, which is basically the entry load. When you have redeemed it at a slightly lower price than NAV, which is the exit load. Both cases you made money. Whom will this money go to? This money will all go to your existing unit holder. So, opening units 300 lakhs, 18.75, 5625 lakhs. Then portfolio appreciation is how much they themselves have given, some 425.47. This is over a 3-month period, April, May, June. This is the appreciation, the portfolio. Then income of April, how much? They have given 22.95, which is what we took here. Where is it? 22.95. Then same income of May, income of June. You have 3 incomes. Then dividend. How much dividend did you declare? We already know here the dividend that we declared is 71.9019. So, you subtract the dividend. Then fresh money that has come into the system. How much? 6 lakh units. At what rate did you issue? 19.2015. So, into 19.2015. So, 115 lakhs. Then money that is redeemed is 3 lakh units, and what is the price at which they were redeemed? 15.5640. So, you minus that. Finally, you sum up all of these, you get a value 6140.9109. And this divided by 303 will give you 20.2670. This 20.2760, ideally, if you come and look at this, the dividend number here and all of that stuff, this should not be so high. So, if you look at the simple working, 18.75 plus 0.1017 should be 18.85. But instead of 18.85, you have a slightly bigger number, 20.2670. Why are you having a higher number? Because you charge some load. That load value is, you are getting it and it is divided by. So, I am storing this. Let me show you, 18.8517. Okay, now what is the total money that you have made because of this entire entry load and exit load? You have made here 0.3750 into 6 lakhs, 0.3750 into 6 plus how much you have made here? 0.3750 into 3, 0.3750 into 3, or we can actually do 0.3750 into 9. So, basically 3.375 lakhs you made. This if you divide it by 303, you get 0.011. That you add to 18.85, you get 18.96. Plus, you have the portfolio appreciation, 425.47. So, you add those two, you get a number which is actually equal to 20.267. So, basically, if you look at the numbers carefully, you realize that the appreciation is allocated to all. The gain made on account of entry load and exit load is also allocated to all. So, this is a very, I won't say it is a very lengthy question, but it is lengthy if you make mistakes. Okay, especially you have to understand what is happening here in dividend reinvestment. A lot of people, what they do is, I'll tell you the mistake also what usually happens here. Usually what people do is, when the second time dividend is declared, they don't consider the first time value. So here redemption new investment is at 0.0765. Second time when you have income available at end of May, you don't consider the first dividend. That is a mistake. If you don't consider, it's a mistake. So 0.1125 is the dividend for the period. But when new dividend equalization reserve is coming in or going out because of fresh investment or because of redemption, the previous period dividend, which is undeclared as on date, also has to be accounted for as part of the dividend equalization. Okay, so this is the concept. It's a fairly simple one only, but thoda small, slightly lengthy, especially if you tend to get confused. So be careful. Practice this kind of questions carefully. So this concludes the revision session on mutual funds chapter. It's a very interesting and very simple chapter. You need to know only very few concepts, but also please note there are sometimes that questions can be asked where they integrate questions from chapters in bonds and where they actually integrate questions from chapters in portfolio management or questions from chapter like portfolio management where they give you Sharpe ratio, tenor ratio and all that. You have to remember concepts what you learnt in the previous chapters because sometimes questions of mutual fund chapter can have tricky questions which include those concepts, right? So this is very, very important chapter. I strongly suggest that you study this chapter carefully. It doesn't take too much time. There are 5 or 6 varieties of questions. There are hardly 1 or 2 formulae. If you know all of that, you will actually be through this chapter. Okay. So that concludes this revision. All the questions, the solutions, the compiler, the formula sheet, the theorem aspects, everything is available in PDFs on our website. If you want to download those, please go and check the description below. Do share, like, subscribe this particular video. Please share your feedback or comment and we'll be more than happy to get back to you, assist and do anything that is required for you to succeed in your exams. All the very best.